To SBI, and I have been given a intro of Mr. Swaminathan, and I find it very, very hard to just read through this intro. I remember Mr. Swaminathan from long back, and I'll delve into the realms of history, my history with him. And long back, when both of us were in IBG, he had just returned from New York. I had joined from Circle, and then we were working together on a trade finance solution for the bank, for the international part of it. And we worked so closely there, he on the business side, I on IT support side, and we managed to upgrade the bank's trade finance solution before the bank's domestic vertical did, which it did 4 years later. And that, in that brief 1 year or 1.5 years collaboration, I realized his dynamism, his ability to actually hit the nail on the spot and call it out, which was very, very important when we deal with so many different verticals. So from that background, and then he went on, and he had spent considerable time in the US, where he had built a huge book of trade finance. And then when he came back after this, he went on to helm the financial institutions group at IBG, followed by a Circle stint, which is the gold standard in the bank. When you had a Circle, and he handled the Telangana Circle, and very, very successfully. And after that, he was immediately promoted. He came to digital, then he went to became the CFO of the DMD Finance of the bank, because the RBI by then, and by this time, I'm assuming that he's not with RBI, he's still with SBI, so please excuse my saying anything like that. So the RBI later, by that time, had said that CFO has to be an outsider, not necessarily within the bank. So he was DMD Finance, which he accomplished fantastically. He remembered all the numbers in the quarterly results and so on. And then he came to digital, and finally, he was promoted as managing director, and both of us joined on the same day on 28th January, and he got risk compliance and stressed assets, which later on I also got from him, and then subsequently I also got corporate banking subsidiaries from him. So somehow this is a process which has been going on. But I remember his speech just across in the other hall on the other side, when he was managing director, risk compliance and stress assets at one of our, I think, best branch managers and regional managers conclave. And he talked about ethics in the bank. What does it take? He had a prepared speech, he just let it go, and he just talked, I would say, extempore on ethics. What would it take for a branch manager in a bank or an officer in a bank to have an ethical behavior? It's more a question of not the rules, but the spirit behind the rules. And this was such a good speech in 10 minutes, that Mr. Ashwani Bhatia, who we were expecting today and is not here, actually congratulated him and said that you really spoke from the heart, which he did. So I have seen him in various avatars, and now, of course, he has gone to RBI, and he has, while we don't know how to react to this, in the sense that he's a regulator, and regulator, not only regulator, but also supervision, which is essentially regulating all of us. All the inspection reports, our bank will go to him. So we have this difficulty as to how to broach him. But he has made life very easy. He says anybody coming from SBI doesn't need an appointment. He can just come on that floor. He's told his PS, just let them walk in, if only I have nobody else with me. So with that kind of a privilege which he has given to all SBIans, and we do reach out to him whenever we have a difficulty. Mr. Khara, of course, has a direct line, and whenever there's a difficulty with anything, not necessarily the RBI, he just reaches out, and Mr. Swaminathan is able to provide solutions. So with that kind of a background and that kind of a relationship, an SBIN will always remain an SBIN, even if he is in RBI. And I would argue that despite this position being normally reserved for bankers, Mr. Swaminathan brings to the table skills and experience which I think haven't been seen for a very, very long time. Because the scale of SBI is so large, and his rotation in the bank across verticals, across businesses, has been such. And he incidentally was also heading the Regulation Review Authority. So he helped clean up the RBI old regulations even before he took over. So he is in an eminent position to actually take over, and we have seen the early results of this already happening. Because he has been on this side, he understands what are the difficulties of business, as also what could be the risks which are building up. And today, because I had a brief conversation with him as to what question I asked, should I ask, and he said, you can ask anything, but I would answer what I want to answer. So which is a typical RBI reply. Normally in SBI, we would actually not give such a reply, but that shows that he has already tinged with the regulatory name, which is proper. So he would be talking about the risks which are building up, and the governor has been on record of talking about some of these risks, but at the same time how models have been evolving. So while all of us look to RBI for signals, here is our very own telling us that these are the risks which are building up and you better be careful. All the banking community or the financial service industry, be careful. So with a lot of privilege, with a lot of happiness, I welcome Mr. Swaminathan to deliver his keynote address. Thank you very much.
Good morning, everyone. At the outset, thank you so much for the welcome address and the introduction. I'm afraid actually my speech actually is going to be shorter than all the introduction that two of them did. So I'll try to at least speak a little longer than that. Thank you very much for this kind of a pleasant welcome. It's like personally homecoming. So I was a bit surprised when Mr. Tiwari walked in to say that he will introduce the speaker. But I'm so thankful to each one of you for this opportunity. So Chairman, State Bank of India, Shri Dinesh Kara, distinguished panelists, speakers, and the audience, the managing directors and the directors on the board of SBI, and my fellow banking community and from the fraternity and the industry, and ladies and gentlemen. I'm delighted to be here at the 10th edition of the SBI Banking and Economics Conclave, surrounded by industry leaders from the banking and the financial sectors, leading economists, policymakers and other stakeholders. This marquee event provides a platform for discussing pertinent issues, sharing insights, and exploring potential solutions for the industry. As I said, in a lighter vein, after being part of its host institution in all its 9 editions, I now have the honor of being invited to speak at this prestigious event. So I'm extremely grateful to Chairman Shri Kara for this opportunity, and I will try to live up to the expectation that was set by both Mr. Shetty and Mr. Tiwari in terms of what my speech might contain. So as mentioned by Governor RBI in the recent monetary policy press conference, the years 2020 to 23 will perhaps go down in history as a period of great volatility. The global economy today is witnessing a renewed phase of turbulence with fresh headwinds from the banking sector turmoil in some advanced economies, which happened earlier in the year. We have few bank failures, and its contagion risk have brought financial stability and resilience issues to the fore again. Therefore, the theme of this year's conclave, Building Resilient Brand India Amidst Global Uncertainty, is highly topical in the current economic scenario. The term Brand India refers to the overall image, perception, and the reputation of India as a nation. It encompasses a wide range of elements, including the country's culture, heritage, economy, innovation, tourism, and many more. Today, I would like to focus on Brand India and its resilience from a financial sector perspective. So, building a resilient Brand India from a banking and economy perspective includes aspects of financial stability, risk management and crisis preparedness, sound corporate governance, as well as adaptive regulation complemented by robust supervision and financial inclusion and customer protection. So as compared to the situation, say, 5 years ago, all of you would agree the Indian banking sector stands tall, reflecting its strength and viability. As of September 23, the capital to risk-weighted assets ratio of scheduled commercial banks stood impressively at 16.79%, underscoring the sector's resilience. The gross non-performing assets, the GNPA at 3.25, is at a decadal low, and the net NPA at 0.76% is again the least that we have seen in recent times. The uptrend in profitability has continued in its fourth consecutive year, with return on assets at a healthy 1.3% and return on equity at 12.5%. As compared to 2018, from a supervisory perspective, as compared to 2018, when 12 banks were under prompt corrective action, today we are glad to say that there is none under a PCA framework. As we note the current state of our financial system, it's also imperative to reaffirm our commitment to maintaining and building upon this position. Our journey towards resilience should not end with achieving these impressive metrics. It requires a continuous dedication to sound financial practices, prudent risk management, transparency, and ethics. We need to remain steadfast in our commitment to upholding the elevated standards that we have achieved, ensuring that our financial institutions remain resilient in the face of any future challenges. A vibrant and resilient financial sector is the sine qua non for a country's growth and development. As our economy strives to grow in an evolving and uncertain macroeconomic environment, it's imperative that the financial system in general continues to remain resilient through the uncertainties to fuel the economic growth. In our financial ecosystem, the strength of individual banks is the bedrock upon which the edifice of financial resilience stands. So I believe a resilient, future-ready bank needs to look at three major aspects. One is being financially resilient. What do we mean by that? Financially resilient is through adequate capital, liquidity, and earnings. The second is operationally resilient, so as to deliver critical services to customers even in times of disruptions. The third, and most importantly, is organizationally resilient, to anticipate risks early and absorb them efficiently. So it's financial resilience, operational resilience, and organizational resilience, I would imagine, are probably the three key pillars upon which, if at all we want to build a resilient brand India, that we will work on. So in this context, I would like to divide this into 6 aspects for the day. Maybe these are the 6 key themes on which you may want to work on in the upcoming period. One is the interest rate risk. Effective management of interest rate risk is a crucial aspect of prudent banking. Recent regulatory changes, notably the symmetrical treatment of fair value gains and losses as well as removing restriction on HTM, have given banks greater flexibility in managing this risk in their investment portfolios. However, considering the dynamic nature of the interest rate risk, the banks must proactively manage and mitigate this as well. The enhanced NIMs that banks are presently enjoying may not be sustained in the future when the interest rate cycle reverses, whenever that happens in future. So external benchmark linked loans, which constitutes almost half of the portfolio today, will be repriced much faster than the deposits that were contracted during the peak of interest rate cycle. So this will bring pressure on the NIMs and eventually the profitability. So therefore, apart from the interest rate risk in the trading book, banks must be mindful of interest rate risk in the banking book as well. Ms. Kara used to mention this often in the board deliberations, that oftentimes the interest rate risk that lies on the banking book is generally relegated to a few minutes of discussion, but I think in today's scenario, it requires a prominent place in our list of priorities. On the liabilities side, banks must endeavor to proactively manage the pricing and duration of their deposits while trying to diversify the sources and optimizing on the mix of deposits, the product mix. Excessive reliance on bulk deposits that we see today in certain institutions should be avoided, as these are more sensitive to interest rate movements and perpetuate concentration risk while possibly eroding the earnings. Coming to the second theme is the business models. This is something which, as a regulator, we have been speaking about it for the last couple of years, and globally there is a greater urgency in terms of efficacy of business models. As the recent global events have demonstrated, sometimes even models once perceived to be safe can fail. Therefore, banks need to remain alert to the risks inherent in their business models and mitigate them in a timely manner. In good times like this, financial institutions must review their growth plans while putting in place adequate risk management systems to handle the emerging risks. It's imperative for boards of banks as well as NBFCs to fix suitable sectoral and sub-sectoral exposure limits and monitor them closely to avoid any sectoral concentration, adverse selection, or dilution of underwriting standards. Because in good times like this, there is every likelihood that we may become complacent or get carried away. But these golden rules of banking, of avoiding concentration risk, adverse selection, and dilution of underwriting standard, I think should remain paramount on any given day. Good times, bad times, doesn't matter. The other aspect of business model which I would like to highlight is the growing collaboration between banks, NBFCs, and the fintechs, which is driving innovation in products, services, and business models. An important consideration is the cautious adoption of model-based lending through analytics. Banks and NBFCs should exercise caution in relying solely on preset algorithms, ensuring that these models are robust, regularly tested, and recalibrated as needed to maintain a robust underwriting standard, because today it has become very fashionable to say that we have an end-to-end digital product, which is fine, but at the end of the day, it's the humans who will have to take a call in terms of whether that model is yielding the desired results from time to time. And the assumptions that were true probably at some point in time may not remain true always. So recalibration of the models, the validation of the models is very, very essential. Then the third theme is the operational resilience, third aspect under the three themes which I mentioned. There is the ever-increasing adoption and usage of digital channels by members of public. So it has become imperative for banks and payment system participants to ensure uninterrupted availability of various online and mobile banking channels at all times, 24/7, 365. Recently, there have been a few incidents of unscheduled downtimes inconveniencing several customers. It is also observed that many banks have not been spending fully. This is something which I would like the boards to take note, is that the banks have not been spending fully the budget earmarked for procurement of IT systems and especially IT security systems. This is kind of an industry-wide trend that we see. While there is no lack of budget, but we find the utilization ranges anywhere from 40 to 60% of the budget, which means that we are behind the curve in augmenting our systems. So the infrastructure, therefore, should be commensurate with their business plans and also monitor them for continued availability and stability. Banks and other ecosystem participants must have robust disaster recovery and business continuity plans in place and test them periodically as well. Further, IT infrastructure and channels have to be protected from the emerging cyber threats to ensure operational resilience. I would therefore like to reiterate that the boards and IT strategy committees of the banks need to step up their oversight in this matter. The fourth theme is about the outsourcing risks and then managing the third-party dependency that is building up in the system. While we acknowledge, as I mentioned earlier, that there are numerous advantages that outsourcing can offer to the bank, such as cost savings and increased efficiencies, a faster time to market, but it is crucial for banks to maintain vigilance regarding the accompanying risks. These risks include potential loss of control over critical operations, the risk of data security breaches, heightened dependency on third-party providers, and the possibility of reputation damage from the misconduct of the service providers. These are all some of the risks which we would like the institutions to be aware of. While, of course, we encourage collaboration, but these are risks that should be kept in sight always. As the RBI time and again reiterated, outsourcing does not absolve a bank of any of its obligations, and they continue to remain ultimately responsible for the activities of their service providers, including the recovery agents. Banks must ensure that their service providers employ the same high standard of care in performing the services as would be employed by the banks if the process was not outsourced. So banks should engage in any outsourcing, or rather, I would say banks should avoid engaging in any outsourcing that may result in their internal control, business conduct, or reputation being compromised or weakened. The fifth theme is the climate risk. Of course, no speech is concluded today without alluding to the risks that are emanating from this particular aspect. So it's to be appreciated that we are living in an era when climate change and its consequent risk cannot be ignored. Due to its geographic, environmental, and economic characteristics, India is particularly vulnerable to climate change. Variability in monsoon patterns, coupled with temperature change, impact crop production and affect our food security. Apart from agriculture, even in other sectors, the economic impact of climate change in India could be substantial. Climate-related financial risks pose both micro and macro-prudential concerns. Climate change risk is ascending the hierarchy of threats to financial stability across advanced and emerging economies alike. And consequently, the need for an appropriate framework to identify, assess, and manage climate-related risk has become imperative. The last of the 6 themes I thought I should highlight today is consumer education and customer protection. Lastly, and perhaps most importantly, I would like to discuss the aspect of customer protection which is integral to building a resilient brand India in many ways. Financial services exist because of their customers. They entrust regulated entities with their hard-earned money, their dreams, and their aspirations. Therefore, customer protection and timely grievance redressal forms the foundation of trust and reliability, contributing to the overall resilience and reputation of the brand. I would therefore urge banks to have a proactive approach towards resolving customer grievance issues by identifying and addressing the root cause of these issues. Customer complaints should only be rejected after careful examination by the internal ombudsman. To do this effectively, regulated entities must ensure that the internal ombudsman is adequately empowered and resourced. Last year, RBI had issued guidelines on digital lending to address concerns relating to delivery of credit products and their servicing through digital route. These guidelines inter alia endeavored to promote transparency by requiring a standardized key fact statement which should contain details of annual percentage rate, the recovery mechanism, the grievance redressal officer designated specifically to deal with digital lending or fintech related matters, and the lookup period. So the KFS is gaining traction, we are glad. And they should also contain any fees or charges, including penal charges, which are not mentioned in the key fact statement, cannot be charged by the regulated entity. However, we are still coming across instances of non-compliance with these guidelines, requiring us to take supervisory action, including imposition of business restrictions. I would therefore urge the industry to review and strengthen its compliance with all regulatory instructions on customer protection and grievance redressal. Then coming to so these are the 6 themes I've covered. Now coming to, in general, about the regulation and supervision, I thought maybe a couple of paragraphs I should cover. Before I conclude, I would like to reflect on the role of regulation and supervision as well, which are essential components of a resilient and stable financial environment. The regulatory framework lays down prudential standards and guidelines which are designed to mitigate various risks, including credit, market, operational, and regulatory risks. The RBI is endeavoring to make its regulations more principle-based, actively or activity-oriented rather than entity-oriented, and proportionate to the scale of systemic risk. The recent initiatives on scale-based regulation for NBFCs, tiered approach for UCBs, and harmonization of certain regulations across regulated entities are examples of this regulatory stance. Further, countercyclical and macroprudential measures are also used to address systemic issues such as the recent revision in risk weights for certain segments of consumer credit and bank credit to NBFCs. On the supervisory side, the initiatives taken are aimed at identifying risk and vulnerabilities early, putting in place a structured early supervisory intervention framework to mitigate the risks, increasing the focus on root cause of vulnerabilities, and harmonizing the supervisory rigor across various segments of the financial system. An endeavor has been made to build a proactive off-site surveillance mechanism to identify emerging risks and assess the vulnerabilities across the supervised entities for timely action to mitigate or manage these vulnerabilities. So the aim is to make supervision more forward-looking, proactive, and preventive, which will promote resilience and financial stability. So, in essence, building resilience in the banking and economy sector for Brand India is about establishing a foundation of strength, stability, and adaptability. It requires a holistic and collaborative effort from the financial institutions, regulatory bodies, government, and other stakeholders so that India can not only weather global uncertainties but also emerge as a dynamic and resilient player in the international economic landscape. With this, I thank you for inviting me and allowing me to share my perspectives in this forum today. I'm sure the deliberations in this conclave will be very productive and result in significant value addition to the industry participants. And my compliments to the organizers for a well-coordinated event, and once again, thanks to Chairman SBI and all of you for this opportunity. Thank you.
Thank you, Mr. Swaminathan. But we're not done yet. Like we were mentioning, it's going to be very interesting to watch how a former and current SBI member do talk. So right now, we are going to have that question and answer session. For that, I would also like to invite back on stage Mr. Ashwini Tiwari to take this ahead.
So I think the theme of SBI and to SBI has been taken up given by the announcer. So you covered 6 themes and also the principle behind regulation. They virtually cover the entire gamut of risk management as far as banks are concerned. And so while each of them is important, and the challenges you've highlighted before the banks, some of the recent instances, ultimately leading to the resilience, because if there are any of these risks were to materialize, how does the bank come out of it and customers are protected? But considering the current environment, what would you recommend the banks should do to handle these risks in order of priority? Because many of them conflict with each other, many of them conflict with the objective of growth and so on and so forth. So what would be the priority, let's say 1, 2, 3 actions by the banks to overcome these risks?
Yeah, I know, it's a good question, so I will have to probably I will continue on the same theme of what I spoke and try to sum up. So if you ask me what are maybe 3, 4 key things that the banks must be prepared for. But I think maybe we can, if you slightly look back, maybe the last 25, 30 years of our professional career, we have seen certain major events that had impact on the economy and financial stability of the world, whether it is East Asia financial crisis or the global financial crisis or COVID-19, and more recently the failure of a few banks in the West. Each of these crises had its origin from different sources. So the impact of them on the economy and the financial sector, the measures that were to be taken, and the outcome across the globe has been varying. So it is very, very difficult to lay down a particular model that will be kind of future-proof, that we can be sure that if we do these 3, 4 things, that we'll be safe for the next 20 years. Because every single time a crisis of that nature hits us, we learn new things. So keeping that in mind, what is that we could do as financial institutions or banks? Maybe, number one, I would say that in good times like this, build adequate risk buffers so that both expected and unexpected losses, if any, can be absorbed. So when I say risk buffers, maybe augment capital, build provisions, ensure that we have enough money stored for a rainy day, wherever you can park. So build risk buffers, number one. Number two is strengthen your risk management functions and give them a free hand in terms of validating the business models that we pursue, so that any inherent risks that is building up in an existing or a new product is understood in advance. So strengthen the risk management functions. Third, I would say, provide good governance and give a pride of place to the assurance functions. Because any amount of capital that you hold is not going to save the institution if the governance or the internal controls or the compliance is weak. So I would imagine that a good governance at all times and a gold standard of compliance will help you if we are going to face any difficult times. Lastly, I would say, invest in technology as if there is no tomorrow. Because ensuring operational and business resilience is going to purely dependent on our ability to maintain a steady, safe, secure, and scalable IT architecture, without which it will not be possible to maintain resilience, that too when a crisis hits. So just to sum up, I would say augment your risk buffers, strengthen your risk management, ensure good governance, and invest in technology. Maybe.
That's really succinctly put. And I agree with you that no amount of buffers or capital or provision can protect against bad governance, because banks are in the business of leverage. So the leverage will be high in all cases, and therefore it's better to be safe rather than to just fall back on capital. That's for unexpected losses. But touching upon climate, I think you raised a very important point. Climate risk, India is particularly exposed. In fact, there is data out there which says that in South Asia, and including India, Bangladesh, Pakistan, I think these are the areas much more vulnerable, being in the tropics, than many other areas elsewhere. So with that mindset, and you touched upon how do we create a framework about climate risk and how do we measure and provide for this, I believe RBI is in the process of coming out with some framework on measuring the climate risk and how do you assess that. But nevertheless, in terms of how do you mitigate this by financing some of the climate mitigation measures, is something which the banks are today focused on. And while RBI has come out with the green deposit framework, yet there have been dispensations the banks have been asking. So for example, on the green deposit, which has a intensive compliance cost and no customer is willing to accept a lower interest rate, banks have been asking to maybe give a dispensation on the CRR. Similarly, on the climate mitigation finance, perhaps including that in the priority sector to some extent has been requested. And similarly, risk weights also, maybe some dispensation can be given there. What is the RBI house view on many of these requests which have been made at different forums?
Yeah. Green deposits, of course, if my memory serves me right, is very recent, maybe June 2023. So it's too early to form an opinion on that, the success or otherwise of it. I'm sure that it will gain traction in the days to come with increased awareness and also banks' own ability to popularize this product and go for it. I'm also aware of the industry demands, as you mentioned, about a lower CRR or a lower risk weight or a possible PSL tag for the green financing, etc. See, these are aspects which will require widespread consultation and also an impact analysis of what it would be in terms of the effect that it will have, because any regulatory dispensation has both intended and unintended consequences. So we will have to think through in terms of how do we accommodate these demands. They are in the works, certainly we are in discussion, as you know. But my thoughts are twofold. One is that while of course the regulatory measures are in works in progress, like for example the climate-related financial risk disclosures. We have been working on the standards now. We are also working on the climate risk scenario analysis and stress testing. These all are part of consultation, and then these guidance notes will be soon in place, and we will have a framework. But this is not a problem that can be addressed only by regulatory measures. There has got to be increased awareness and a proactive adoption of practices which support green banking. Because ultimately, if our goal is to achieve net zero by a certain time, and if as financial institutions, we have a responsibility to ensure that we put our money where it matters. So I would imagine that the banks will work on their own internal policy framework in terms of their own risk appetite framework as to what they would like to do to achieve the kind of goal that they have set for themselves. In the meantime, we will work with the industry to see to it that the guidelines come in position in a manner in which it is facilitative of achieving these objectives.
Yeah, that's really well said. The only thing is that some dispensation like this can just nudge the banks towards this direction, and the regulator performs the nudging function well. And I would hope that that includes the emission measurement methodology as well, which is something the entire industry has been waiting for some time. Coming back to your macro-prudential measures, which you mentioned, that some of the recent measures, especially on NBFCs and unsecured loans, one of the challenges we as a bank, and I've been speaking to some other banks as well, and all of us feel the same way, is that in NBFCs, while the growth has been good and banks have been lending to NBFCs, but in each NBFC case, we find there are 30, 40, 50 banks and non-banks also increasingly. Sometimes even fintechs are lending to NBFCs, which seems weird, but that's the reality. and each bank is lending a very small sum. Now, while in our view, it is hard to actually get a clear picture about how the NBFC is performing because each bank will be getting a separate list of assets, etc. Do you think the regulator has any thoughts on how can a better follow-up and a supervision happen on such kind of a lending? Of course, increased risk rate is one way, but that, in my personal view, is a slightly blunt instrument, which will, because there is a last mile connectivity which NBFC brings, and the PSL requirements many banks have, which banks are not able to fulfill. Those are genuine demands or genuine use cases of NBFCs which have to be accounted for. So keeping that in view, is there something we can do to actually improve the governance of how this is going on to protect the whole system as a whole?
Yeah, thank you. I know it's a big question anyway. There are two parts to it, as I understood. So one is in terms of the macroprudential measures that we took on the NBFC. I'm sure most of you would have had the opportunity to go through the report on trends and progress, the RTP report as we call, which was released yesterday. While the banking sector growth has been about 12.5%, the growth in credit to services sector grew by about 20%, and within which growth in financial sector, which is financing to NBFC, grew at 30%. And it's not just this 1 year, but that has been the trend that we have seen for the last 2-3 years. So a huge interconnectedness gets built when the banks are financing an entity which is in the same sector, which I think likely to pose a contagion risk. It's not that we have seen something alarming in terms of the indicators. All indicators are fine. At this point in time, every single ratio that we would like to monitor, they are all in safe zone. But at the same time, we don't want an extraordinary interconnectedness building up and later posing a contagion risk for us. So that's a precise reason as to why we had to bring certain measures that will curtail that exuberance. So I think that's the first part of my answer. The second part of your question is in terms of number of banks. If you recall, precisely this is what Governor had said in his interaction with the MD CEOs of large banks, the biennial interaction that he has with the MD CEOs of large banks and as well as MD CEOs of the NBFCs in the month of July and August. He highlighted this interconnectedness and also said that today banks have become the single largest source for financing NBFCs. So there was a clear request for them to broad base their resource base so that the risk does not build up in a particular segment. And then of course we have to follow it up with some measures so that things fall in line. Having said that, we have also noticed that the lender group is consisting of 20, 30 lenders, at times 40. You'll be surprised to know there are 40 odd lenders. If you ask the not so well rated NBFCs, their answer is, sir, the banks are not wanting to take big limits, so they are willing to give only small exposure limits because of their own constraints. So we have to approach many banks. If you ask the well-rated NBFCs, they say, no, we have all these limits in place, but we will draw down basis whomsoever quotes the best price on the day of drawdown. So we want to keep the limits in place. So we are maintaining. And from the banks as well, I see a tendency to be in place everywhere because you don't want to be left out, so you become part of the lenders group. And in the process, it's becoming a lose-lose game for everyone. Because neither the risk gets monitored at the underwriting stage because of the large lenders group. And more importantly, in the post-sanction monitoring, there is a complete dilution because everyone thinks that the rest of the world will take care because there are 20, 30 people. But having said that, this is an issue which I think may not be solved by regulation or supervision. This is an issue which banking industry will have to think through. You have to decide whether you want to be one among many lenders, one among the 30, 40, Because if by regulation, if I say that an NBFC should not borrow more than 10 banks, then it will be very prescriptive and restrictive. That's not something which will solve the problem. What is more important is, I think the lenders as a group will have to take a call in terms of what should be the way going forward, so that we have good underwriting standards as well as good post-sanction monitoring standards. So I would put that back to you for a solution rather than coming from me.
He had actually warned me earlier that this is going to be put back to us only. But nevertheless, the point about post-sanction monitoring, I think, is the more important point. And while I understand the point that RBI is now increasingly moving to principle-based rather than being prescriptive regulation, maybe a consortium-based approach, or at least a joint lenders forum for the NBFC where large number of banks are present, could be one answer. So far, every NBFC which has approached us has asked for a deviation for even a joint meeting of all the lenders. So that is not something which I think is good for a post-sanction monitoring. So we'll let it rest there and try to work out a solution between the banks itself. I'll now come to a very important point you raised about the resilience, the operational resilience part, unscheduled downtime, etc. You also pointed out about the cyber risks which are there. And this is an ongoing thing. I mean, it evolves all the time, and we have this challenge. And it's a matter of time before some element or the other, some player or the other will be able to get into some bank or the other. There have been past instances. So do you think that in terms of, suppose a bank were to be hacked, how does one bring back the bank? Because the challenge before banks is there's a production server on which the main data resides. There's a backup server which actually replicates almost in real time at most banks. So there could be a hypothetical situation where the threat actor comes in, corrupts the primary server, is replicated to the backup server as well, and sometimes they come and get activated with a lag time rather, and then we have a challenge as to how do you bring the bank back. This was posed actually in one of our meetings with the government as well, and I don't think any of us has a good answer. Any thoughts what could be done here actually?
No, it's a very pertinent question because cyber threat is for real, and irrespective of whatever that you do, the people on the other side who are out to hack can get smarter. And while we have got to be lucky every day, they have to be lucky for one day. So that's the situation. So we have got to be alert every minute. But then, as I mentioned in my speech as well, or in response to your first question, the only way is in terms of investing in IT and IT security as if there is no tomorrow. Build superior skill sets, domain expertise, and put them as on top of your priority in terms of ensuring that the institution is kept out of the harm's way at all times. It's easier said than done. It requires enormous effort. But we also should have very sound BR-DCP policies in place and also practice them in letter and spirit. Oftentimes, as some of these crises plays out, we find a switchover to DR is not as easy as what we thought. And we also realize that certain institutions, when the decision to take to switch over to DR, there is an escalation matrix which takes its time. And after they switch over, in some of the instances as we have seen, there is a situation that it's not exactly mirroring. The DR is not exactly mirroring the DC. So when you switch over, you realize that certain functionalities are not available. And similarly, the recovery time, the RTO or the going back to DC is not being smooth. And we also have realized in the last couple of years the need for an integrated BCP testing. Because people are testing channels. CBS is working, UPI may be okay, but we don't know about internet banking. So we realize as institutions shift from DC to DR, whether it is near DR site or a far site, irrespective of that, we find when we do a root cause analysis, we find this kind of deficiencies. The mirroring is not real time, the applications are not identical, the versions are not common, the upgrades or patches have not been applied uniformly between DR and DC. Thereby, switching to DR or switching back to DC is becoming a painful affair, taking at times many hours. So this is possible to be mitigated if only we do repeated integrated BCP testing, where you will shift all the applications and then see whether you can work. And then the more you do, it becomes more easier. And it's all the more real at this point in time, given the kind of cyber threat the financial institutions faces and the reputational risk it can bring to the institution as well as to the country. It's important that we strengthen the investment in the infrastructure, monitor them real time, and have DR and BCP practices which are real time. Thank you.
I think the granularity you brought to that question, there is some element of the SBI experience coming in. Otherwise, this kind of knowledge of what exactly could go wrong in different phases of DR is just not possible. But that, I think, is extremely important. And I would just add that a bank like us and others as well have to move on to do the tabletop exercises of scenario planning of when things do go wrong. That, I think, is extremely important, because otherwise it will remain a theoretical exercise. But thank you very much for your time and the candidness which you brought to the questions, despite the regulatory threshold which is always there to cross or not to cross. It has been a real pleasure to listen to you once again, as always. Thank you very much.
It's my pleasure. Thank you.
All right, sir, I request you to please stay on for just a minute so that Mr. Khara can come up and give a shawl as a token of appreciation, as well as the green certificate. Thank you, Mr. Swaminathan, and thank you, Mr. Khara, as well. Moving on now, over the last couple of years, we have witnessed a marked rise of the regulators aimed at keeping regulated entities and the market ecosystem in a controlled and well-protected environment. The regulatory pitch has evolved over the years into a harmonized act. The Indian financial markets are well respected and looked upon as a mature ecosystem. In that context, our first discussion today looks at the quest for a harmonized regulator and market ecosystem. So I would like to invite all of our panelists now. We have Pramod Rao, Executive Director of SEBI, Mr. Shashanka Bhide, Member of the RBI MPC and Emeritus Professor of the NCAER, Supriya Bhattacharjee, CGM, Department of Banking, Regulation and Development at IFSCA, Siddhartha Mohanty, Chairman of LIC, as well as S. Narain, CIO of ICICI Prudential Asset Management. Also the moderator of this panel, Mr. Alok Kumar Chaudhary, Managing Director of Risk and Compliance at SBI.
So, start, sir. Very good morning to all of you. As Mr. Sethi, the opening speaker, has already said, it is an offbeat session. Not only in the content or the composition of the panelists, but also if you see the entire program chart, you will find that Latin has stolen some space from English language. This is the only panel where you have CTS, LTS, 4TS, and many of us have already added these Latin words in our personal lexicon. We also had the situation where the real life issues have already been flagged. So on the one hand, yesterday we had the national aspiration calling us to take bolder and bigger moves for achievement of the national objectives. But today, the regulator has already cautioned us, given us something which always is important for keeping the country in a state of financial stability. So, before we enter into the quest for a harmonized ecosystem, let me set some context to this entire panel discussion. So, COVID in the human history will always be considered as an event which reset a lot of things. In the sense that the way individuals, society, social institutions operated, acted, everything changed. And post-COVID, 22-23, there has been a very interesting but strange phenomenon, which you call as the rise of the regulators. The regulators were always laced with regulatory powers, power of supervision, primarily aimed at keeping the regulated entities in safe lanes so that the economy and the society moves in a sort of preordained safer system. However, COVID changed the entire, relationships in terms of demand, supply, in terms of loss of livelihood, in terms of, inter-institutional relationships. And this led to a situation where the regulators had to, start daring acts of engagement with the regulation itself, so that in the highly tumultuous environment, the whole financial ecosystem and the society doesn't stray away from the path of growth and survival. Now, if you see the central banks, they were all besieged in a catch-22 situation. Now, as the pandemic ebbed, we found the regulators, particularly the central banks, they were attempting or endeavoring to step away from the myriad and massive quantitative easing measures without, jittering the markets. Whenever the inflation prints, they reared their heads and acted as projectiles hitting the heads, and putting everything into disarray, all the well-crafted plans, plan B or plan C, of everybody, the regulators and the regulatory entities, they were all put into disarray. Now, in such a seemingly insurmountable space, where we didn't have playbooks which were already played in the past, and we didn't have, a kind of space to understand that whatever regulator is doing is right, but still, we found suddenly in a very short period of time, the regulatory pitch which we used to hear suddenly evolved into a very harmonized act. In a harmonized act, in the manner which nobody knew earlier, but it happened. How it happened? Because of some uncanny wisdom, some unparalleled sort of forbearance, strategic vision, continued reforms. All these led to a situation where the economy and the society were in safe hands and the safe zone. Now, this has created a situation which is a kind of Goldilocks moment, a kind of optimum moment for broader markets to enter into uncharted, new and exciting areas of growth. And such a situation, and the laurels which we all are hearing about India, has not been an easy journey. It has been quite bumpy, starting from, 1990s when the LPG onset was there. Thereafter, you had the Asian financial crisis, the greater financial crisis, the European debt crisis, and the temper tantrums of 2013, each of these crises kept us still insulated from the outside world. Now, in all these crises, there were always learnings. The regulators always picked these learnings, but they never stopped. They kept the, say, intensity of reforms going on, keeping the common man at the center of everything what the country does. In this situation, you will also find out that the regulators also brought out different kinds of concepts, mainstreaming certain concepts like whatever it takes. It has become a common parlance. Now, saying that yield curve is a public good. Now, these statements have become mainstream, and under these circumstances, I think the regulators have done a very wonderful job. Now, today, if you see, India has emerged as a country as a bright spot. Now, the world around says that India is the brightest spot in the world. It's considered as a matured economy, which is ready to connect itself with the seemingly flow of funds, investments across jurisdictions and different asset classes. Now, we also see that the volatility which we, volcanic activity which we saw in different parts of the world in terms of financial, say, mischiefs created here and there, in India, we find that our indices, the rates, the currencies, they never embraced disorderly volatility. They always kept volatility within a range. And I think that the regulators in India have done a wonderful job. But as they say, to borrow, say, simile from physics, all systems have a tendency to go for higher entropy. So disorderliness will always come. So whatever we have done, whatever is being done, there will always be some scope for improvement, some wanting, some nuts and bolts missing here and there. Under these circumstances, we have a panel today. We are fortunate enough to have a galaxy of eminent speakers who have made names for themselves and who are actively thoughtful in the work they do. Today, as we embark on this quest for finding a golden mean between regulation or regulatory benefit and regulatory costs, I think this session will surely add new perspectives to even the panelists themselves, but also to the audience, leading further space to further Socratic dialogues to follow hereafter. So with this context setting, I would move towards the panelists just to sort of understand the perspectives in various areas. So, as we talk of finance, the capital markets, they always come as a first thing in the mind. So I'll start with Mr. Pramod Rao from SEBI. So, as you see that Indian markets are scaling new highs, FIIs are finding Indian markets attractive, the DIIs are channelizing, say, resources from a humongous middle class. A huge number of retail investors, they are swaying more towards the non-cash segment of the market. In these situations, how do you think that the market regulator will deal with this, say, a non-traditional kind of challenges which the economy faces? So what is your take on this regulators' answer to these challenges while keeping the structural reforms in a just right situation in terms of intensity, in terms of impact? So over to you, Mr. Rao.
Thank you. Thank you so much. I think the way I would sort of characterize it is two elements, which have, especially in the last 5 years, but I think it's a broader trend all across. The increasing retail participation has also been on the strength of SIPs, has been on the strength of mutual fund folios growing dramatically. I think each of it has meant that the FII flows, which were, the manner in which the markets behaved have sort of got tempered with this Atmanirbhar, if I can call it that, moment that has come to our markets. So I think that's something to both acknowledge and celebrate. But it also casts, I would say, some level of, how should I put it, burden on us in making sure that the retail investors are indeed protected. I heard the DG as well speak about consumer protection. And I think for us in the markets, it becomes investor protection. And really, those are the themes with which we sort of look at various aspects. So like you said, the huge participation in the non-equity segment. To us, when we commissioned a report and it sort of revealed that a lot of, 90% plus of the trades actually result in losses for those people participating in that. We made sure it was published, it was widely disseminated. But we went on to equally require brokers who facilitate this actually displaying this as a warning, saying that this is something you should be aware of. To me, there is only so much a regulator can do in terms of making sure that that knowledge is indeed, transmitted, that awareness is brought. If I had to compare it, and I say it, as a former smoker, but it is almost like the tobacco industry, if you will, right? You can put those labels that it is injurious to health, but finally the person who's picking and deciding to smoke, you can only sort of, tax it maybe to a level which dissuades them. And I think in the budget as well earlier this year, that's what the FM also did for this segment. So to my mind, I think working on those themes is the way I sort of look at what we can do. But yes.
Yeah, so just a follow-up question, understanding that we need large number of investors in the market for filling the needs of the Indian entrepreneurs. And the fact that our investors, the new investors or the old investors, they are in a continuum in terms of experience, in terms of their own networks for understanding the market. Do you think that the regulators and the regulated entities together need to create some kind of, need to be more vocal and more prepared for strengthening the retail investors? Because, see, the point is that the human endeavor to create wealth will always take people to faraway lands. Though, like in the past, we had people going for gold in unknown areas, right? So that's a human tendency. So what should more be done in order to protect these retail investors that they don't get out of this entire investing business?
So, again, I would desist from sort of wanting to become a nanny state. I think trying to overprotect the investors or over-engineer some of these things is really not called for. I think what is called for is, and we, unlike a Reserve Bank, we are a disclosure-based regulator. So our emphasis is constantly on making sure that there is investor awareness and knowledge as they participate in products. But to me, a lot of it also depends on our regulated entities. So if I had to, sort of say, a first-time investor probably is best placed to enter the market through the mutual fund route. And to me, that sector has itself seen tremendous growth, is on the back of AMFI making sure that that sort of campaign reached not just tier 1, but tier 2, tier 3 cities. We are trying to engineer that or sort of encourage that around REITs and InvITs. Because again, we see that as real assets which investors should hopefully be able to understand and take benefit of. Similarly for municipal bonds and so on. But to me, it is a journey. It is not something which we will accomplish overnight. And again, some of these, I should say, are accompanied by the learnings, as you alluded to, from what lessons we have seen in the past. So, for instance, in the corporate bond space, we have actually created a backstop facility, both by the industry and the central government stepping forward. That is meant for unusual situations where indeed bond liquidity might dry up. So the backstop facility is to safeguard against those situations.
Yeah.
If I had to look at in regular course, there is now a bond repo clearing company. Again, it sort of is to make sure that there is liquidity at the time that major investors require that. So several of it is, I think, driven by making sure that there are institutional mechanisms now in place than ever before in the past. But like I said, it's a journey. I think in this journey, the investors being educated, being aware, and indeed investor protection, riding high on both the financial distributors and manufacturers is what will make the market better.
Yeah, thank you for your perspective. I think it has really added to the understanding. So I'll come back to you later. But now I'm raring to go to Dr. V. But I would like to listen from you, from a perspective which you have. India's GDP growth is a story of, success and applause on all the fora. That is a country with bright prospects. The numbers have already vindicated this stance. Now, how do you, as a regulator, counterbalance the prioritization of growth over inflationary concerns, more so in the context that the supply side shocks and the vagaries of climate, they are like a specter haunting all of us. At any point of time, they rear their head and all the plans go haywire. So under these circumstances, how does the regulator do this act?
Well, thank you, Chairman. And I would also like to thank thank SBI, I think, for inviting me to be in this panel. It's a privilege for me to be here amongst a very distinguished group of regulators, bankers, and so on. So thank you very much. As Mr. Swaminathan had said earlier, I also believe in minimizing risks, and so as something that I would like to get out of the way is that I'm not emeritus professor at NCAER. I think I'm an honorary senior advisor at NCAER. I've had a long association with NCAER. And sort of second risk mitigation point, I think, is that I'm a member of the MPC. I would have felt a lot more confident if the two other members of NPC were also here. So in any case, I think, I just wanted to make it clear that I don't want to take credit for lots of good things that the RBI has done. So I think, so the views that I have here are personal. So, Mr. Chairman, I guess you drew attention to the balance between growth and inflation that well, must keep in mind. I think the MPC has a mandate, I guess, to rein in inflation to the target, but it also has the objective of supporting growth. So I think it has always been this balance, I think, that was important. And as you mentioned, this term of MPC actually has, it began with the COVID pandemic, I think. So in that sense, I guess, these choices were very stark in front of us. The growth which had slipped and the inflation at the same time, was very high. So at that time, clearly it was the growth that took priority, both because I think it was at a point which was very, very, very difficult to accept, I think, that status of the economy at that time. And there probably wasn't very much that could be done by way of the only instrument that the MPC has at its dispensation to influence inflation, because most of these shocks were also coming from the supply side, the supply chain disruptions and so on. So I think the last 2 years have been this roller coaster. When we felt that we had some handle on inflation, so something else came along. And so there were many of these supply disruptions during the year. So at many points, I think there was an indication that we were looking at moderate rates of inflation. So whether it was to do with the failure of the monsoon, whether it was to do with the conflicts, geopolitical conflicts, whether it has, but a lot of concern in the last 1 year at least has been the problems that the advanced economies faced. So I guess many a times we have had this point that, these shocks were external, exogenous, and that is not something that originated within the economy. But clearly, the implication to the domestic economy was very, very direct and very significant. And as I said, the only instrument that we had was this policy interest rates. But I think we had the liberty to take the other option that was before us, which was to communicate the intent of policy. I think whether it is the stance of policy or whether it is what impact the present policy has had on the economy. So I think these were far more important to influence the inflation expectations. So while the growth itself, I think, was driven by the domestic demand, domestic policies influencing domestic demand, and so on. But I think there was this other option that the MPC has had, which was communicating clearly, I think, where we are going. So let me just make one last point, which is today, right? I think the present context. So if you look at the impact of monetary policy actions by which the inflation is to be influenced, so at least personally, I felt that we were looking at GDP growth of 7.2% last year. I think we were projecting a GDP growth of 6.5% for the present year. So here it was the impact of sort of more conservative or sort of more cautious monetary policy, which was looking at a moderate growth and probably looking at an inflation moderating down from the upper band of the upper level of the band of inflation target. But now we are here looking at a growth rate of about 7% for the GDP for the current year. It's marginally lower than 7.2% that we saw for the last year. So I think there are these unexpected sort of changes that happen in the economy. I think we have said in our own statements also that the Q2 growth for the current year was significantly more than what we were expecting. So I think this change so the changes, even when they are more positive, more favorable, I think they require more concern, I think. So two points that I wanted to mention. At least I believe that there are vulnerabilities to this growth assessment, in the sense that there are a few major drivers of this growth. On the demand side, I think it's the investment which is driving growth. We see weaker growth in consumption demand. We also obviously do not see the external demand being the major driver of the economy. On the other side, on the supply side, I think we have had this weak monsoon for this year, and therefore it has some implications to agricultural growth, to the rural demand, and so on. So I think there are these concerns. And finally, I think there is this issue that we have been highlighting for the last 2 years, the great uncertainty. I mean, it was a year of great volatility, but I think the last 2 years have been years of great uncertainty. And so we have these conflicts that have the potential to affect those supply chains globally. We also have, somewhat slow recoveries in economies that is taking place, particularly in China. So there are these issues, I think, that are important in looking at the growth dynamics today. On inflation, I think we have had declining core inflation, but at the same time, I think we are more concerned about the food inflation at this time. So I don't think there's a very clear answer to what you said, Chairman, but these are my perspectives.
Thank you, sir, I think only you could have simplified this complex decision-making as it goes. Now, picking a point from your, speech or discussion, let me paint a picture of what the country looks like now. So, as we see that MPC has of late been committed towards the withdrawal of accommodation, so that the inflation aligns itself to the target, and of course with the intent of supporting growth. Now, the forex reserves in the country is just right. It's diversified, signaling. It's a sign of, I think, a de-dollarization move, the way the forex reserves have got increased and diversified. And the GDP numbers, as we have already seen. There are also things which RBI is quite aware of and gives ample attention, maybe in terms of the fact that the technology integration and dominance in the financial landscape is changing the understanding how financial market to compete within the space as well as outside the space. Plus the bank-alike entities which are dotting the entire financial landscape, almost threatening the banks to leave a space for them. So what is the preserve of banking in terms of, say, proprietary data, in terms of the payments as well as deposits and advances only being routed through the bank? So, and the third part, the impetus towards more consumer-centric, smaller loans, all these issues are catching the attention of RBI, and they are sort of mulling over it. But this, say, collage of positives as well as challenges for RBI, what do you think as an insider, as well as also as an outsider, because understanding your space there, what do you think are the big material challenges of 2024 which RBI perceives? Number two, how does RBI think of dealing with it? So with whatever inside information and outside understanding you have, and which you have in ample measure, I think we'll be interested to know about that.
So I guess this is where one of my risk mitigation efforts has failed. I think. So I was hoping that the two other MPC members would be here to answer those questions. But let me also say that sort of in a in sort of more broader context. Mr. Swaminathan also mentioned about technology. And so things that have happened, obviously have a lot to do with what has happened with technology, I think. All the, the new ways of doing business and so on, has affected the landscape that you mentioned, but it also affected, I think, how the regulations have to see this. So, has the impact of monetary policy, for example, transmission of the monetary policy on the economy. Is it affected by these changes in the landscape, right? I mean, so I think these are questions, I guess, that need to be looked at. So we need to be clearly, recognize, I think, what has happened. And there isn't, I think, a very clear, very clear answer, I think, to these questions. So I guess it is, we also, there's one other indicator that we always look at as a positive indicator for the economy. It is the growth of credit. So is that growth of credit an indicator of, intentions on investment? Or is it an indication of lack of adequate income to finance whatever investments that have been made? So I think the issues that as we go forward, I mean, in 2024, I think, so there is this phase now of managing the economy, managing the growth of the economy when the external environment continues to be weak. I think all the projections for 2024, for example, say that the global economy is going to be weak. So there may be surprises there, but I think so the coming year, whether the domestic demand itself will be able to sustain the growth and take this growth, I think, what is now expected to be better than 7%. So I think when not all engines of growth are not firing, is it possible to sustain this growth? does this growth, is going to put pressure on inflation again? So because we are looking at, I think, a growth which is not inflationary. So are we in a position to manage this scenario where we are looking at acceleration of growth, but at the same time, I think, maintaining the moderate levels of inflation?
Thank you very much, sir. So let me now go to the newest regulator on the block. So if you see that you as a regulator has a very tough task on hand in terms of establishing IFC in a very short period of time, and as it is important for the country in terms of positioning it as a go-to crossover between, say, the international financial platform, which gives seamless global connect to the domestic economy, and also gives a place for properly priced products and services. Now, under these circumstances where the economy, where there's an impact of higher for longer environment, how do you think that you will, or IFC will, say, harness the opportunities in order to give a leg up to the domestic economy, which is in need of funds?
Right. Thank you, sir, for the question. Yeah, you are right. IFSCA is a different kind of a regulator because although all regulators have a developmental role alongside a regulation, in the case of IFSCA, it's probably more pronounced because you have to actually create a jurisdiction side by side as you are regulating it. Our job is, as you said, hard, but as we speak internally, sometimes that it's hard as well as easy at the same time. It's easy because, it's pretty clear what we need to do. There are jurisdictions like Singapore and Hong Kong which actually have done it. So the playbook is there. So we don't really need to reinvent the wheel from that context. It's very, very clear, obvious what the steps are required to be done. The challenge is really to do it within a framework which is not built for our international financial center kind of a situation. So, for example, what we did initially when IFSCA took over is we did a benchmarking exercise to see how our laws stand vis-a-vis the laws of Singapore, Hong Kong, or even London. So, because what the feedback we got was that at basic level, we need to provide what these jurisdictions provide to have even a chance of competing with them. Forget about displacing them. So there we found that, it's all possible, but it's a question of degree, it's a question of context. Our laws are not meant to be, starting with the banking laws to the securities laws. Currently, as you know, we have all the powers of all the sectoral regulators like SEBI, RBI, but we are also all the laws of India apply unless they are expressly said not to apply. So that's really the challenge here, and which we are trying to solve incrementally today by taking exemptions from certain laws through a mechanism which is there in the IFSCA Act, which allows certain exemptions to be provided. But going forward, I think we will have to look at a day when these laws are rewritten. For IFSC, like has been happening in Dubai. Dubai essentially has one law for its domestic area and one law for its international financial center in banking, securities, contracts, and all that. So that's where we are coming from. We haven't really seen any huge difference. In fact, the interest in IFSC as a route to investing in India has only grown in the last year. And one of the areas that has really surprised us is the growth in the retail business. Because for the first, if you take 2015 as the setting up time of IFSC, it was largely a wholesale kind of a zone, where you had banks dealing with banks lending to funds, funds bringing through money. Last 1 year, we have seen a substantial growth in retail interest. For example, I can tell you that banks in IFSC had almost zero retail deposits beginning of this year. The volume has gone up to $800 million. It's small in the context, overall context, but it's significant that, even retail customers are coming in today and, placing faith. And once you have retail customers, you can provide services like wealth management and all. So higher for longer has not really affected us that much, and we in fact see a good traction from that side.
Yeah, thank you very much for the answer. Now, just extending from here, see, the global financial centers have been, having a big boys game, right? Starting from, say, Hong Kong, Singapore, New York, London, Shanghai, and of course a bit Zurich also. Now, seeing these centers, which are already dominant in the market, and also the fact that different nationalities flock towards those centers, creating melting pots in all those places. Now, how do you, as a regulator, position yourself on a front footing so that all those markets, and particularly in the waning influence of Hong Kong, are you prepared for front forward kind of perspective and positioning?
Right. So there are basically two aspects to it. As you said, there is the the legal aspect, and there is the social aspect. Social aspect is really not in our hands, but as you might have seen in the recent some of the news items, the powers that be are really focused on that, and some major steps are being taken, not only from the one that is in the news, but in other areas also, to make the place more livable, so that you attract more and more people to work there. From the legal aspect, as I mentioned in my last answer, it's really how do you marry the Indian laws to the practices that prevail globally. If I might give an example just to elucidate what I wanted to say. There's a concept called acquisition finance, where basically a bank lends to a company to acquire another company. Now, under the BR Act, Banking Regulation Act, Section 19(2) says you can't, other than a subsidiary, you can't hold the shares of another company beyond 30% of your share capital or the share capital of the target company, whichever is lower. And essentially, because of this regulation restrictions, all acquisition finance that happens in India, wherever they are financed using borrowed money, happens either through NBFCs or through SPVs or from Singapore or Hong Kong to some extent. So when we started out, there was a requirement. Some banks came and said, "No, we want to do this out of IFSC, but this is the problem that is being created." So what we did then internally was we looked at the laws, banking laws of Singapore and Hong Kong, and we found that almost the exact same restriction is there. So because it's a good policy, the policy itself is not a problem, that a bank should not hold stakes in other companies. That's absolutely sound. But there was a proviso in the Singapore law which says that if the stakeholding is as a result of a business operations, that is, you have lent money to somebody who has defaulted and you are then holding that shares, that is allowed, provided you sell it off within 5 years. So what we then did was we went to Government of India and said, see, look, this is what is preventing, both Indian companies when they want to acquire companies abroad, or when foreigners want to acquire Indian companies, both ways, we are not able to finance these transactions. So in the recent budget, the Honorable Finance Minister actually amended the BR Act to the Finance Act and allowed acquisition finance to happen. So these are the kinds of issues we are grappling with. Till we have a whole recast of the laws for IFSC, this is going to be the way it's going to happen. But today we have a good template. In the last 3 years, we have sort of understood what we need to do. I mean, that's the first step, that what do we need to do really. So the next step is, in the next 3 years or 5 years, we'll probably go in implementing it. And I think once we do that, and with the social issues now being addressed, we will have a platform at least where we can then claim that we are at least at par with Hong Kong and Singapore in terms of the facilities that they offer.
Yes, sir. So great explanation. I think the Gift City laws and the Gift City in itself, lesser number of people know it because you always need a context to understand. But the way you have elucidated about Gift City, it gives us a lot of reassurance that is a unique regulator which is supposed to act both as a nurturing parent and a critical parent together. I think we are assured that this is in safe hands. So good luck to you in this. Now, coming to you, sir. So, LIC, as we know, is not a proper noun. It's a common noun because still majority of the people say LIC karaya kya. Understanding that you have bought an insurance policy, but people would say LIC karaya kya. So that kind of legacy, that kind of trust which you have of the market, of the millions of people in India who have put their savings in insurance, and they are fighting against gods because of you, because they understand that whatever endeavors they make in life, and if something strikes, then it is LIC, Jindagi ke saath bhi and Jindagi ke baad bhi. So with this, you also, because of the investments which you have in large numbers, you also are a market participant as well as a market maker, right? And we have, on the other hand, your regulator becoming more and more, say, active in this space, both for widening the insurance space, both deepening it, and also for promoting competition within the market. So as a regulator, I think for the last couple of years, your regulator has been quite active and had charted different paths. But from the perspective of LIC, what are your perspectives on the insurance regulatory environment as of now, and how should it proceed further?
Thank you. Actually, if you see as LIC as a group, we are regulated by multiple regulators, starting from IRDA, RBI, SEBI, MCA, all. So our experience is very unique, and as you told, our regulator IRDI, they are more into now development of insurance, and objective of central government as well as regulator as well as all of us by insurance for all by 2047. So in that direction, lot of initiative has been taken by the regulator. They call Bima Trinity, Bima Bistar, women-centric distribution system. Bima Bahak is women-centric distribution system. Bima Bistar is a composite insurance product where life, property as well as health, one product. So that is being developed. Then Bima Sugam, e-marketplace for customers to buy policy online. So those are being developed. And now regulator is going from rule-based regulation to principle-based regulation. Similarly, solvency-based capital, now initiative has already been taken to risk-based capital, so that more capital is at the hands of insurers, so that they can deploy for more acquisition, customer acquisition. So these are the initiative regulator is taking. At our level, LIC, because we operate in market and we are the largest domestic investor, I must thank all regulators, because post-COVID, everyone experienced how government as well as all regulators in unison managed very, very efficiently risk management, stability, innovation as well as competitiveness, then investors' interest, consumer protection, everything. I can say regulatory landscape is at a mature stage in India. That I can say from my experience as LIC and what we experienced from COVID, post-COVID response, and the way we are managing our economy thanks to all the regulators and government. So we are at a mature stage. But when society grows, issues will also come. Morning we discussed, now also some of the panelists, environment issue is in front of everybody. So how fast we address the challenges arising out of environment change? That's one thing. Second is a technology change, cyber security. So all regulators and everybody in this system, we have to respond very fast and very effectively, because society is changing very fast in all these areas. And for me, it will be little selfish to say, because as LIC, when multiple regulators are there, there are certain issues. Some issues will be process related, some policy related. Like a small issue, I can just share. Suppose acrylic. I am largest participant in a debt market. I have no access. And my assessment and appraisal on basis of whatever public domain reports are there, financials, I do on that. So I would be happy if we are given access to acrylic. That is one thing. Secondly, new asset class also, because we are highly regulated. Insurance companies, so far as investment is concerned, it is highly regulated. So new asset class also should be allowed, like your sovereign gold bond, ETF equity derivative. All these things should also be allowed to insurance companies, so that there will be more liquidity, and similarly also long-term paper. I would request Dr. Bhide Sahab, actually they have helped us earlier. I got some 40 years, 50 years paper, but more and more such papers we require, because our asset liability management, we have to, liability is long-term. Suppose if I sell pension policy, pension is as long as the policy holder is alive. So long-term liability, but asset short-term, so there will be mismatch. But I am thankful they are also helping us. So that is also our need as insurer. We also require. So these are some of the things which we expect from the industry. But definitely we are in a mature state, and it will further develop. Thank you.
Thank you, sir. You have touched a very raw nerve in terms of multiple regulators and coordination between multiple regulators, because as you know, you touch one nerve and the other nerve gets affected. So we'll come back to later on this aspect. Now let me go towards you. Say, mutual fund industry has been a roaring success. So in the last decade, if you see, from an AUM of 8.9 trillion, it has reached almost 50 trillion. But still, if you see the, say, GDP, AUM to GDP ratio, it is still at 16%, while the market cap is more than the GDP. Under these circumstances, there is a need for, say, bringing more and more people. Like yesterday we heard NSE, our Sri Ashish Chauhan, who said that his desire is to have at least one investor in each pin code, and there's only a few left now. So from that perspective, what do you think should be done to create wealth at the bottom of the pyramid and bring more and more people to mutual funds, so that 50 trillion becomes another 100 trillion in a very short period of time? So your thoughts on this?
I think thanks to good regulation, the mutual fund industry and AMFI, I think the growth rate, I don't think we can crib about. Every year the growth has been fantastic. If you see the last 10 years, I would say the growth has been fantastic. And I think if you look at it, along with very good regulation, technology has also helped it. Because earlier to invest digitally, small amounts of money was a problem. Today, thanks to digital KYC and even investing through all these internet modes, you're able to invest small amounts of money also. So there is very little problems in growth as we see. The only challenge, if you look at it, is post-2020 COVID, the industry has become more or less an equity industry. What happened was there were some credit events in 2020. And after those credit events, people have just forgotten debt. And if you make it an only and much more equity-centric industry, the risks will come when equity comes down. Because debt is a more stable asset class. And today, if you look at the mutual fund industry, no one wants to talk of debt mutual funds at all. Everyone wants to talk. And if you look at it, even the smallest company can get money in equity. But you try any of the other people, you can't get money in debt mutual funds today. And I think it's important that there is a development role that needs in debt mutual funds, because till 2020 there was a debt mutual fund role. But now increasingly I come much more from an equity side, but I feel that the industry has to become much more debt oriented also for growth. Otherwise, I would say the equity part of the industry is booming. I don't think the SIP, SAEI campaigns have also worked very, very well. I don't think there is any crib that we have, and regulation has been very supportive. So we've seen a very, very positive attitude.
Yeah, so thank you very much. But you have also ended towards a fault line of more and more towards equity, and the debt market needs to be more richer and developed in order to give people a sense of perpetuity in this mutual fund. Rather, they should not flee away from the credit events which are bound to happen in this kind of industry. So coming back to you, if you see that the stock market is booming, right? There's a single word which encompasses all emotions. More and more corporates are getting listed. People are, getting money from the stock market for fueling their own entrepreneurial ambitions. But you have instances where, say, the rating agencies, we often find chinks in their armor in the rating agencies. You see FinInfluences kind of getting cult status and being the new Pied Pipers of today in terms of financial landscape. And in this spectrum, you will also find that there are companies, not only at the top end of the spectrum, but even at the bottom of the Nifty. You will find that there are opaque trading patterns, right, which causes some kind of investor distrust, or say investors' confidence in their mind when it understands that everything is not perfect. There are some elements which can suddenly change the entire contour. So how do you balance this? Because it's known that capital markets are critical for a country's growth, because you need risk capital which can come from there. So, fueling the risk, capital markets, and also seeing that these elements which cause distrust and cause winters of funding, so to say, how do you create a balance in this?
So indeed, the way I look at it is that the capital market regulator, SEBI's role has indeed been of balancing, and balancing of, I would say, I call it a trioca of investors, of intermediaries, and the issuers. And I think we will continue to have this dynamic play out. As long as there is investor confidence, I think issuers will come to the market. Intermediaries benefit both by serving investors and the issuers. And I think that's the only real way forward. But some of these elements that you mentioned, I think it's also about how we deepen and mature as a market. To a large extent, I think, whether we see the top 50, 150, 250, and so on, I think there is a growing trend of understanding that market rewards good disclosures, good performances. And I think that's the drivers which hopefully assist both investors and issuers. Like I said, the newer asset classes, equally the REITs, InvITs, when we look at corporate bonds, which indeed Naren has mentioned as requiring a mutual fund impetus as well to support. But I would go on to a slightly different theme of saying the institutional investors in form of insurance companies, in form of pension. These are also the bedrock of our corporate bond markets, right? And to me, as long as issuers see the virtue of these institutional investors, and if we can grow the retail participation like we have in mutual funds, which again we have taken in initiatives, for instance, to bring online bond platforms into the regulatory perimeter. I see that as a potential way of expanding the retail footprint. So each of this is with that intent. In terms of what should people expect, I think everybody expects fairness, they expect transparency, and they expect that if these two are not met, that there is a disciplining force. And to me, that disciplining force is often what gets us our press, but really it is building the, entire pillars around fairness and transparency that probably goes unnoticed. But that is where our efforts.
No, thank you very much. So, what we've done so far is that a regulated entity and its regulator. So it has been a kind of unitary deep dive into that particular regulator and the regulated entity. Now, as the last leg, as we're approaching the end, as the last leg, I'll have some simple question which has emanated from Mr. Mohanty. as he has said, that if you touch one part, the other part gets disturbed. And when in this economy where everything is getting holistic, there are interdisciplinary movements, and nobody is an island. So under these circumstances, what do you think, sir, to start with you, what do you think should be the pathway for inter-regulator coordination in a manner that the regulated entities, they don't feel so constrained because of one regulation, and they have to fight for change in other regulation. So to simplify the question, what should be the pathway in a very short term for a harmonized inter-regulatory coordination so that the regulated entities feel emboldened to act?
I think the one of the things I guess people have observed today, that we have had the good fortune, I think, of a more harmonized regulatory environment at this time. And I think the, I don't know if there is a easy sort of way to achieve this, but obviously I guess the environment during crisis is very different from environment in normal times. I think so. The common sort of public goals, they should drive the regulatory agenda also. And so I guess, it's often said that it is the consultations ability to do that. Obviously, that is what needs to be promoted. The only concern, I think, in all this is the independence of the regulatory agenda, right? I mean, each regulator has an agenda, and so long as there is no conflict in this, I guess the common sort of interest, I think, should guide this.
So, yeah.
Just in addition to what Dr. Bhide said, actually some framework should be developed so that there is a regular interaction between all the regulators where market participants should also be there. They should also directly discuss, they should plead their case, so that I think many issues can be resolved. Yeah, and a certain issues definitely at a higher level, policy level, government level, legislative level. So those will be there, but many small issues we find can be resolved. Yeah, thank you.
So, same question to you.
So, what I can reassure all of you, being a regulator, is that we have intense level of regulatory discussions, interregulatory discussions. I'm myself a member of IRTG, which RBI chairs, and where the three other regulators also join us. We have FSDC, under which we have several forums set up under the subcommittee where we compare notes. So what I can tell you is we do note comparison. I think we end up working at different speeds for different reasons. I think Professor Bhide hinted at that in terms of that our regulatory approaches are, for instance, a regulator like RBI is shaped with prudential, guidance and frameworks. We are shaped more by disclosure-based approaches. So I think those are where we take a little more time in convergence. But it's not to say we don't do note comparison. So yeah. I want to tell you that we do that.
Thank you. Thank you very much. Your views on this.
No, I think as far as IFSCA is concerned, we are, there's a high level of coordination. In fact, Mr. Rao is on our board as one of the members of representative of SEBI. I should also stress that from my experience in RBI and now IFSCA, a lot of informal interaction also happens, which is, if not as important, even more important than sometimes the formal interaction. So there is, as Sir mentioned, FSDC and on those structures are there. So I think we do well in terms of regulatory interactions and coordination. I just stress that the informal channels are also as important as the formal ones.
Right. Thank you. You have...
To give you an example, we own shares in banks on behalf of millions of investors. So there's a 5% limit. Now that 5% limit is we are actually effectively our trustees own it. So that 5% limit caused a lot of trouble to us, because end of the day, we are not owning on behalf of our sponsor or anybody like that. Even when Lemon failed, Lemon's mutual fund didn't fail, because the AMC is owned, all the mutual fund owners own it through the trustee. So these kind of things come. I don't have the bandwidth to talk on these inter-regulatory issues, but we get into these 5% limits. For example, we have these index funds. Now these index funds are becoming big due to EPFO. Now, due to that, some 10% limit will get hit that will not be able to buy any shares in some of the companies. So the index funds being put into a 10% limit causes its own trouble. So these kind of small things keep coming up, which are more smaller things, but these all are part of these things.
I think it requires a day to discuss these things, because if you see, for the last 3 years, I think 3 to 4 years, this 81 issue has been sort of mired into controversy in terms of the RBI's action. Also, a concomitant or subsequent action by SEBI in restraining the mutual funds to invest in 81 bonds with different caps and different valuation norms. So there are issues which need to be handled, but the only hope, as I understand, that OECD had, I think in 2021, they had published a paper on Regulator 2, which talks amply about interregulatory coordination. And one of the first fundamental things which it suggests is huge amount of stakeholder consultation. That before you regulate or before you make any laws, huge amount of stakeholder, the users' consultation is required, because laws, unless until they are easier to comply with, will either be unused, underutilized or flawed. So from that perspective, I think interregulation coordination is something which is the order of the day. The Western countries have already understood this. And India, as you say, that you all do your note exchanges and things like that. We think the panel, I think on behalf of you, if you allow me, I can say that the panel recommends that there should be more and more discussion around interregulatory coordination, so that the common good of the country is achieved without the frictions which can be disturbing and destabilizing. So the panel has done its job, but still can do. So we have around 7-8 minutes time, where if you can further enlighten us, so that we can put some pressure on our grey cells in order to respond to your questions. So if you have some questions, we'd be happy to try answering. Will not be I'm not sure we'll be able to answer, but we'll surely give a fair try. So time is up. Thank you very much. Thank you very much for appeasing this.
Thank you to all of our panelists, and thank you, Mr. Chaudhary, as well. I request you to please remain on stage for just a bit, and if Mr. Khara can please come and hand over the mementos. All right, we now have another very special address lined up, but and this is going to be with Mr. Sanjeev Sanyal. But before that, I would like to call on Mr. C.S. Sethi to take us through an introduction to this brief. Okay, I'm just going to repeat that. We are going to have a very special address by Mr. Sanjeev Sanyal, but before that, Mr. C.S. Sethi, can you please come and give an introduction?
Yeah, good morning once again. So it gives me immense pleasure to introduce Mr. Sanjeev Sanyal. I don't think he requires introduction. He's one of the most visible faces today. But still, I would like to just briefly outline his bio. Sri Sanjeev Sanyal is an Indian economist and popular historian. He's a member of the Economic Advisory Council to the Prime Minister of India and has helped prepare 6 editions of the Economic Survey of India starting in 2017. Sanyal has written several books on Indian history. I think some of them are extremely popular. He has begun working in financial economics in the 1990s. In 2004, Sanyal and environmentalist economist Pawan Sukhdev created the Green Indian States Trust to promote sustainable development. Sri Sanyal worked as chief economist for South and Southeast Asia Deutsche Bank until 2008, leaving for researching and writing his immensely popular book, The Land of the Seven Rivers, and returned in 2011. By 2015, when he resigned, he was a managing director and global strategist at DB. He's also served on the Future City Subcommittee of the Singapore government, tasked with building a long-term vision for the city-state. In 2017, he was appointed as the principal economic advisor to the Indian Ministry of Finance, and in that job helped prepare, as I said, 6 editions of the Economic Survey of India. In February 2022, he was appointed member of the Economic Advisory Council to the Prime Minister in the rank of the Secretary to the Government of India. Ladies and gentlemen, put your hands together to welcome Sri Sanyal on the dais.
Good morning, ladies and gentlemen, and it's indeed a pleasure to be back here in Mumbai. As some of you already know, I actually began my career here as a banker in this city, working for a French bank called Société Générale. Most of you know that I worked for Deutsche Bank for donkey's years, but I actually started my career in Société Générale. In fact, in an investment banking unit of it called Société Générale Crosby, which doesn't exist anymore. And when I joined it, the office was in Nariman Point. And the first day I joined, I was told that I was supposed to have a bank account so that I could get my salary. And of course, Société Générale didn't have a banking license for retail banking. So I walked out of, I think, Maker Chamber 4 was where the office was. And I walked out and I looked around to where is there a bank where I can get myself a bank account. And lo and behold, just across the road, there was a State Bank of India branch. So I went across and got myself a bank account. And I'm proud to say that I still have that bank account, although now shifted to your Central Secretariat New Delhi branch, and I still get my salary there. So yes, I'm here, many links to you, a banker for 2 decades, started my career here in Mumbai, and still used my SBI account. Now, we meet here today at a turning point, of course, because we are at the end of 2023, going into 2024. And what a journey these last few years have been. I mean, my God. 4 years ago, that would have been at the turn of 19 to 20, who would have known that the following 2 years would be spent essentially in the middle of a lockdown caused by a virus emanating from a city in China that none of us had ever heard about. And in the middle of that, sitting there in North Block trying to manage an economy in that kind of flux, it was difficult to envisage that, 4 years later, we would be in a position to call ourselves the world's fastest growing major economy, that we would be in a situation where we would be saying that, look, here we are, world's 5th largest economy now, but in the next few years, maybe 18 months from now, we will go past Germany to become the world's 4th largest. And another 18 months after that, we expect to go past Japan and become the world's 3rd largest economy. So this is a real turning point at multiple levels. But I think to understand what we are doing right now, it's not enough to understand it in terms of these annual growth rates or even these rankings, but to really understand the fact that we are not just me, all of us are not just building an economy. We are actually rebuilding a civilization. And to understand that, you have to go all the way back 1,000 years. So 1,000 years ago, India was not just the world's largest economy by some margin. We were 33% of world GDP. In fact, we were the world's largest economy for pretty much all of human civilization till about the year 1200, and accounted for 1/3 of world GDP. This was where the best universities were. This was where refugees from around the world would escape to. This was really the center of the world in multiple ways. And I'm going to describe to you how the world would have looked 1,000 years ago. So that's just a description of what in the subsequent several centuries we lost. So that you appreciate when we are rebuilding today, where we want to eventually be. So if you were an economist in the year, 1023, let's say, and you looked at supply chains around the world, what would you have looked at? The world's sort of the anchor supply chain on which the world's economy functioned, basically functioned through the Indian Ocean. And was a supply chain that began in the Eastern Mediterranean, which was controlled then by the Fatimid Empire of Egypt. It was a Shiite empire. And the supply chains then set off from there through the Red Sea and the Persian Gulf, through to India and the coasts on the west coast of India, and specifically to the Chola Empire, which controlled at that time much of southern India. So it controlled much of what is now Kerala, Tamil Nadu, southern Karnataka, southern Andhra, and so on. And of course also the Maldives, Sri Lanka, and so it had a significant maritime presence. And from there, the supply chains then went through to the ports on the east side, through particularly a port called Nagapattinam, which still exists. And from there, merchants would sail across to the Southeast Asia, to Indonesia, what is now Malaysia, Thailand, and so on. And then they would make their way first past. And there were two ways of doing this. One of them was through the Malacca Straits, which was typically controlled by the Srivijaya Empire of Sumatra and Malaysia, or Malaya, and through the Sunda Straits, which was the straits between the islands of Java and Sumatra, so if you know the geography of that area, and that was usually controlled by the kingdoms of Java. And then they made further east, they would make their way through to Korea, Japan, but most importantly, to the Song Empire of China. So this was the trading route, and all kinds of things were going back and forth. So there were silks from China making their way through. So there's a lot of talk about the Silk Route through Central Asia, but in fact, most of the silks that eventually ended up in Europe actually came by the sea route. There was a far more important route by some margin. And then there were spices from the Southeast Asia. What the Europeans called Indian spices were in fact, except for black pepper, which is an Indian product, almost all the other spices are actually Indonesian. It's just that the Indian merchants were buying it from the Indonesians and selling it to the Arabs, who then sold it to the Europeans. And then there was India, which was of course exporting black pepper. But also importantly, we were a major textile hub. In fact, for much of history, we were a major exporter of textiles. We still are, but cotton is an Indian plant. And even if you go back to the Harappan period, you'll find India exporting cloth. And very interestingly, things made from steel. So steel and iron, weapons, for example. So when, for example, the Arabs were fighting the Crusades, they were fighting them with swords made either directly imported from India or made in West Asia using Indian metallurgists, who later on became the gypsies. So the Roma or the gypsies of Europe have their origins on Indian iron workers who went to the Middle East to basically make all the weapons for the Arabs fighting the Crusades. So this was how the trade went back and forth. And of course, with trade came geopolitics. So what happens is, and I'll give you one instance, what happened is that I told you that there were two ways between trade between India and China, and it went through these two narrow straits, the Sunda Strait and the Malacca Strait. And two separate empires controlled them. Now what happens is the Javan kingdoms invaded Sumatra and threatened the Srivijaya kingdom. So the Srivijaya kingdom went running to the Chinese, who then supported them with troops and money. And using Chinese money, the Srivijaya pushed back the Javans, and they were so successful by doing it that they ended up controlling both the Sunda Strait and the Malacca Strait. Now, like all monopolists, guess what they did? They began to extract rent. So they jacked up the tariffs that were to be imposed on goods passing between India and China. Now, this really irritated the Cholas, particularly the king at that time, first Rajaraja Chola, but later on his son Rajendra Chola. So Rajendra Chola saw this, and he sent a warning. In the year 1017, a small fleet was sent with a warning saying that please make sure that you don't do this and open up the channels. But for whatever reason, the Srivijaya didn't heed this warning. So almost exactly 1,000 years ago, in the year 1025, a very large fleet set out from Nagapattinam, crossed the Indian Ocean to Sumatra, on the west coast of Sumatra, went down Sumatra and entered through the Sunda Straits, and then went up the Malacca Straits and sacked all the ports of the Srivijaya. And finally, in a place called Kadaram, which is now Kedah in northern Malaysia, they fought and completely destroyed the army of the Srivijaya. And then they sailed back. Now, as a result of that, the trade routes were opened and trade resumed with lower tariffs. It is also interesting to note that the Song Empire of the Chinese did absolutely nothing to help the Srivijaya. Now, we do not know why that is the case, why they didn't help the ally, but we do know that the Cholas and the Srivijaya later sent a joint emissary a few years, just a little after this episode, to the Song Emperor's court. So it's quite possible that the Chinese actually supported the Indian raid, and it's quite possible that they were just as irritated with the Sumatran attempt to extract rent. So I give you this bit of a history so that you understand that the world we live in is not so different. There are supply chains, there are rivalries, geopolitical rivalries. India and China are still playing a major role in that environment. And let me show you, banks also played a very important role in all of this. Except they were somewhat different from what you think they were. You see, you may have this impression that all this trade that I just described was being done by individual heroic merchants crossing on ships across. That was not the case at all. Almost all of this trade was done by very large organized corporatized guilds. So there were merchant guilds. Some of them had colorful names like the 500. I'm assuming they had 500 shareholders, so they were called 500. But they were huge operations. And these guilds had their own armies, their own navies. Some of them survived past many dynasties, so the empires would rise and fall, but those guilds would still be around. So they had more than capable of defending themselves even against political interference. And you have examples of them turning up in Southeast Asia, and they have inscriptions of how some of these guilds had operations there, and they had their own soldiers and mercenaries and so on. So these were very large operations. And financing them were large temple banks. Now you may have wondered from time to time, why is it that there was such a lot of gold in Indian temples? And somebody may have told you that that's because all the Indian kings were handing over their gold to the temples. That's not the case. Even in ancient times, getting Indian politicians to hand over their money to anyone was very difficult. The reason there was such a lot of gold in the temples was because they were banks, and it was the temples that were financing a lot of the infrastructure, the urban works and so on, but very importantly, they provided the venture capital for all these voyages. So that is where they were getting their money, for basically lending money and financing these. And there are still copper plates which have these contracts written in them. You have tripartite contracts between the temples, which provided the finance, the artisan guilds, which were basically caste-based artisan guilds, which produced the goods like whatever, metallurgical goods, cloth or whatever it was, they were exporting, and the merchant guilds who actually did the trading. So it was a very complex, corporatized system, which if I sent you 1,000 years back, you would entirely recognize. They had letters of credit and all kinds of other kinds of things. And of course, there were, they agreed on certain levels of interest that had to, not too high, not too low, and so on. So supposing State Bank of India existed 1,000 years ago, it's almost certain that your headquarters would either be in Siddhi Vinayak or Mahalakshmi temple. But unfortunately, the world as I just described blew up. And it happened because there were major climactic changes in Central Asia, which caused a huge expansion in population in Central Asia. There was a warm period around about the year 1200, and that led to a huge expansion in population in Central Asia. And these Central Asia then saw these waves of invasions outwards. There were the Turks, there were the Mongols, and so on. And all the three centers of economic activity, the Fatimids and the Middle East, the India and the Chinese, all three of them got essentially devastated by these invasions from Central Asia. The Mongols completely raided and leveled Baghdad and Iran and even attacked Egypt. China, the Song Empire, was destroyed also by the Mongols. The sworn enemies of the Mongols were the Turks, who were pushed into India, and they, of course, devastated all the temples. Now, we typically tend to think of the destruction of the temples in terms of socio-cultural or religious lens. But let me tell you that it was also a major shock to the financial system that ran this huge Indian Ocean-based economic system that I just described. So in case you thought you had a problem with your NPAs and capitalization, let me tell you, Mahmud of Ghazni would have been a lot worse. So this world basically fell apart. All its nodes fell apart. It was then reconstructed in a somewhat different way a few centuries later. For a little while, economic heft moved into the Central Asia because the Mongols were land-based power. So the trade routes that Marco Polo and others used were land-based routes. Of course, the sea routes didn't completely die. Even Marco Polo himself made his way back through the sea route. But nevertheless, it was a shadow of its former self. And even to the extent it survived, Indians slowly but steadily disappeared from it because we didn't have the financial muscle anymore. First the Arabs, then briefly the Chinese, and finally the Europeans took over the Indian Ocean world. And India, that had been 33% of world trade, by the 1500s had shrunk to 24%. Then it, over a period of time, we were bypassed by the Chinese, who under the Ming went through a major renaissance of their own and bypassed us. So even though we had great empires here like the Mughals and so on, in terms of economic heft, even at the height of the Mughal Empire, it was the Chinese that had already bypassed us technologically, financially, economically. And certainly after the British occupation of India and the colonial experience, by the time we became independent, we were only 4% of the world economy. 4%. But sadly, after independence, we opted for an economic model that put us even further behind. So by the time we began to liberalize our economy in 1991, our share of world economy had shrunk to somewhere in around about 2%. And it's from that point onwards it has slowly begun to creep up. It began to rise from the mid-90s onwards. It grew over the last 20 years. So when I say that we are finally coming back as the world's third largest economy and sort of taking back our place on the global table, do remember this long journey. It is not a journey about, quarterly GDP growth rates. It is a journey, as I said, of a civilizational renaissance, a rebirth. And we have to keep this going. This is just the beginning. We require to compound this effort of growth year after year, decade after decade. We have the opportunity to do this. Many things are falling in line for us. Many of the major structural reforms we did over the last few decades across many governments are now bearing fruit. Many of the minor process reforms that we are now doing, the nuts and bolts, they are also bearing fruit. The geopolitical architecture of the world, in some ways at least, benefits us as the world tries to find another source of manufacturing and supplies other than China. So that benefits us as well. We ourselves are going to go over the next 25 years through a demographic dividend phase where we will have a disproportionate proportion of our population will be of working age. We all know that. But all of this requires that we take advantage of this opportunity. Even this demographic dividend, do remember, is a one-time benefit. 25 years, at the end of that 25 years, we too will age. By the late 40s, we will also begin aging like everybody else. And therefore, this is an opportunity we cannot miss. And of course, the financial sector will play a major role in keeping this going. An important part of this has been, of course, the huge experience over the last decade or so of upgrading the banking sector, cleaning it up, changing the supervision and regulation of it, so that we are ready for this 25-year expansion. I'm making this point because we need to see it in the context of other countries that also attempted to go through this massive expansion. Just like we want to for the next 25 years, do remember if you went back to the 90s, it was Southeast Asia that was going through this high growth phase. And then it had a financial crisis. Its banks failed them and they never quite recovered. China, of course, managed to keep it going for a long period. It is now that they are having their banking sector problems. They managed, for a variety of reasons, they were able to keep it going. But it is not obvious that we will manage to do so. They were lucky. At any point in time, they could have easily become another Thailand or another Indonesia. So this is an opportunity, but keeping this going will require that all those people in this room and your successors will have to keep this machine running. This is not a time to slip. This is not a time to make a mistake. We have put in a lot of effort for the last 10 years cleaning this banking system up. Last time it was Mahmood Ghazni. This time it will be our bad allocation. So we can't mess it up. So with that, let me stop and maybe I can answer a few questions.
Thank you, sir. I think it's an extremely fascinating speech, if I can say so. So I'll ask a few questions and then we'll open up to the audience. And, economist, environmentalist, urban theorist, historian, and many more hats. But who's the real Sanjeev Sanyal? Is a practicing economist or a passionate historian?
Well, as I said, I don't think the world functions in silos, so I don't see why I should function in silos. I consider myself a practicing economist, but economics is influenced by so many things. It's influenced by our geography, our history, it impacts the environment and gets impacted by it. So I consider myself to somebody who likes to think about how the whole system-wide machinery works. So in my quest to understand it, I have ended up being in many, many places. And I think once you begin to see it as a whole, you cannot unsee it. So that's where I am at.
Thank you. Thank you. And so you also mentioned that it's not about growth of economy, it's a growth of civilization. And we have seen from your books and many others that geography also shapes the civilizations. In fact, I just would like to quote what you said. Geography is not just about the physical terrain, but also about the meaning that we attribute to it. So I was just reading recently Tim Marshall's Prisoners of Geography, where he elaborates how geography influences global politics. So in the dynamics of geopolitics, what we are going through, how do you see the unique positioning of India, geographical position of India, shaping its economic growth and also influencing the geopolitics, which of course today India is playing a significant role in?
Yes, of course, geography plays a very important role in the way, it's one of the many, but certainly an important factor driving our economic and cultural destiny. But as I said, the way you think about it matters a lot. For a very long time, for some reason, India had a strange sea blindness. Now, why this is the case, I don't know. Maybe because our capital is in Delhi, so we end up thinking in a landlocked way. But as I just showed you from my short speech, India actually is more a maritime country. Now, I don't need to explain this to Mumbaikars who are sitting right next to the ocean, but a lot of our policy making is done in a landlocked way. And we spent much of our last 75 years independent thinking of ourselves purely in landlocked terms. And this is very strange. As I said, not just our history. We are the only country that has an ocean named after us. Right? So this is, and just look at the geography of India. It's about the peninsula, right? So given that maritime orientation, we need to rethink the way we think about the world totally. So for a long time, when we thought of our neighbors, we thought of our friendly neighbor to the west and another one to the northeast. And in both cases, we have had frictions with them. But in fact, if you think in maritime orientation, these are not our only neighbors. Our neighbors are Indonesia, Singapore, Oman, UAE, Kenya, even Australia. In a maritime sense, even Australia, by the way, many people think only of Australia as a Pacific country, but Australia is just as much an Indian Ocean country. In fact, after India, it's the second largest Indian Ocean economy. So these countries, when you think of it, the world looks a much different and more friendly place. These are countries with which we trade. The world is not a place to fear invasion, but a place to trade with. So consequently, the way we interact with this Indian Ocean world and the world beyond changes with the meaning we give to what our neighborhood is. And by the way, interestingly, they give that meaning to it. After all, Singapore is Singhapura, the lion city. It's a Sanskrit name. Indonesia named itself after India after becoming independent. Indonesia. Its currency is the rupiah. In fact, they've got the correct pronunciation. Their national symbol, despite being a Muslim majority country, is Vishnu's Garuda. So these linkages are old, they are deep, and they matter.
Thank you. I think it's a very interesting answer. You also mentioned in your speech, a couple of times, cleaning up the balance sheets of the banks. Many of you in the room also probably would like to know that in the finance ministry, when you are there, when this cleaning up the balance sheets of the banks was thought about, today when we moved from the twin balance sheet problem to a twin balance sheet advantage, a couple of thoughts which come to my mind. I also was sharing with you that I'm a chairman of a board of trustees of the first bad bank formed in the country. It's called Stressed Asset Stabilization Fund. When IDBI was to be converted into IDBI Bank, some of the bad assets were put into a fund. So one of the options obviously could have been creation of a bad bank at that time. But instead, you all opted for recapitalization, cleaning up the banks, the 4 R's which you talked about. So I think all of us in the room would like to be, while we were participants in the whole process, so what exactly went through the policy making and thinking process, if you can share with us.
So I joined the government as principal economic advisor in the finance ministry in February of 2017. Now, at that time, the big economic question in everybody's mind was this banking NPA problem. And it was spiraling out. And by the way, it wasn't just the banks, it was the non-banks as well. So it was pretty bad there as well. And there were tens of thousands of NPAs. In fact, we didn't know the number. It may be running into hundreds of thousands. At that time, literally the number kept bouncing upwards, as you will remember. And, that was the situation. So, in my very first meeting with Finance Minister Arun Jaitley ji, who was then the Finance Minister, so Jaitley ji said that, look, you come from the financial banking world. Why don't you have a look at this problem and figure out some meaningful suggestions? And the big suggestion of that time, which was supported by the then Chief Economic Advisor as well, was that let's create a bad bank and shift all of this bad stuff into it. And there was this discussion, this is what Malaysia did, this is what Indonesia did, even in some sense the Americans did during 2008 in some way, etc., etc. So there was all these discussions about bad banks, shift the thing, and basically get the banks to lend again because the whole thing seemed to be jamming up. So I had a look at this whole thing. And yes, there was a pile of this debt. But one thing struck me when I did the analysis, which, so since I came from the sector, I had a couple of old banking analyst friends of mine in Mumbai. So I asked them to go through these balance sheets with whatever data and tell me from whatever they could find. I also talked to the then chiefs of various public sector banks, also of some of the foreign banks who I knew personally. And this is what really came through very clearly. That although there were literally large numbers of these NPAs, they were very much concentrated in just 50 cases. Something like 50 cases accounted for 65 to 70% of the bulk of the bad loans. In fact, 12 cases accounted for something like 30% of the bad loans, or 25-30% of the bad loans. So I was the one who invented that term dirty dozen, if you will remember it. Anyway, so I went back to Jaitley ji and said, look, I don't think it's a very good idea to create a bad bank. So any of you are enthusiasts of bad banks, I'm sorry, I was the person who scuttled it. And my argument for this was this. Look, we have done some sort of bad bank in the past as well. We used to call it BIFR. What you basically do is you transfer all these bad loans, NPAs, into this warehouse where they will basically fester forever on public money. Meanwhile, the banks will no longer have any ownership of these assets, so they have no interest in chasing them up. There is nothing there to suggest that they will lie there and that the civil service will do any better at running these or disposing of these bad assets. So all you will do is having a warehouse for festering these bad loans. So I made the argument that let us instead use the Insolvency and Bankruptcy Code. Now this was a bit of a risky idea because remember, we had just passed the Insolvency and Bankruptcy Code and it was completely untested. So Jaitley ji looked at me and said, everybody else thinks otherwise. What makes you comfortable that this will work? So I argued back that, look, it is true that we will, ideally you should take the IBC system, test it with some smaller cases and improve it. But the fact is there is no correlation between the complicatedness of a case and the size of the case. And most of the very large cases were not complicated cases. They were relatively simple steel companies and things like that. So we could test it with the very large cases. So initially I was not 100% convinced by this. But I have to say I got a lot of support from a few people, and I'll name them because I think they deserve to be named for the amount of time we spent discussing these issues. One was a banking secretary called Anjali Duggal, who played a very important role in all these conversations. I spent hours going through the numbers with her in her office, drinking large amounts of packaged lassi. She had this large supply of lassi, and it was the summer of 2017 by this point, and we were to sit and drink large amounts of lassi and go through the numbers. There was a deputy governor here, Veera Lacharya, who was an important part of that time. He and I disagreed bitterly on monetary policy, which I thought he was too hawkish on. But on this issue, we agreed and we worked very closely together. There was also another deputy governors, Mundra, and later on Deputy Governor Jain, who were very much there, although they worked a lot more on the NBFC part of the equation. And there was also a Dr. Sahu, who was the head of IBBI, Insolvency and Bankruptcy Board of India. It was, by the way, his support and his confidence that the NCLT system right up front could do 12 really large cases. And then I had this research assistant who I'll also name because he really worked hard at it. So I shouldn't forget him, called Dr. Naveen Bali, who every few weeks had to go through all these top 50 cases, particularly those top 12 cases, and every week gave an update to the system of what was happening in each case, step by step. Must have really driven him mad, but anyway, he played a very big role. So all of this big team that I just described, then got to work, and we used the Insolvency and Bankruptcy Code instead of the bad bank to start cleaning the banks. And once it began to roll, and some of the cases began to get liquidated and the money began to come back, it also changed the entire culture of creditor rights and so on in the country. So even the marginal cases where, that began to tip over, that part of the story very well. And so that is how the whole machinery began to go where today we have, as of yesterday, I believe, the gross NPA ratio of the banking system has dipped to 3.2%. I could not have believed this in the summer of 2017.
Yeah, obviously, I think banks are much more in a resilient position. In fact, yesterday we were talking about when Secretary of Financial Services was making a call for supporting bigger and bolder bets. I think the banks are in much better position to support that now. I'll ask one last question and then open to the audience. You also repeatedly talked about and also given the historical perspective about the supply chain, importance of supply chains. And the recurring theme, what we hear, is that are we getting the right strategy in terms of either leveraging on the China plus one or China plus positioning India should have, particularly from the context that if you see our exports, while the current account deficit is at historical low levels of 1%, we still seem to be highly dependent on the service exports. Merchandise exports have significantly improved. So what is the visualization in terms of our increasing our export competitiveness? Of course, yesterday many of the speakers were also talking about the PLI spurring the growth of manufacturing in India and also supporting the merchandising exports.
So yes, I mean, it doesn't require very much imagination to know that we have been very successful in services exports. Partly it plays to our own strengths, partly it just happens to be the moment in history where services exports has become exportable. An earlier generation couldn't have done it this way. So that is partly true, but I disagree here with some other economists like Raghu, for example. So Raghu's view is that we should just go with services exports, and I disagree with him on that. So while it is true that we will do, well in services, this is clearly an area of strength. I, on the other hand, think that, look, we live in a world where, first of all, not everybody will be able to participate in a purely services-led growth. There is a danger here of also a Dutch disease problem. I don't know if you're familiar with, but basically the Dutch disease is when it's an economic term for a situation where one sector does spectacularly well and the other sectors consequently become somewhat shrunken. And it causes a major risk that if there is some perturbation to that successful sector, it blows the whole system up because the other sectors never grew. So I think given our 1.4 billion people, we have a large internal market, we shouldn't get caught in this idea that, we should have one engine of growth. We need multiple engines of growth. Multiple things happen. I mean, during COVID alone, we saw what happened. Suddenly supply chains in the world blew up and disappeared. Then, we need to be able to manufacture, even for our own purposes, we need to be able to manufacture stuff. And of course, under normal circumstances, there won't be enough demand for all those products adequate for ourselves. So in order to reach global scales, for having technological leadership, we need to be aggressive about exporting these things to the rest of the world, getting our companies to export with the world. This is important because that is what creates a vibrant, mixed economy with all kinds of things are happening. And of course, there's linkages between all of these things. So if we become lazy in the manufacturing part, because a lot of the technological innovation requires your hand feeling the thing with your hands, doing the thing is what gives the technology. So it is important that, if we are going to be a great designer of chips, but by the way, we already design a lot of chips. We don't manufacture any. But if we want to have some capacity to design chips, not only because, supply chains could suddenly dry up, but because if you are not doing the thing yourself and being at the cutting edge of actually manufacturing it, you will at some point be overtaken by people who do. China's success is not just that it was a manufacturing hub. It began to do spectacularly well in all kinds of things like AI because they were doing related manufacturing sectors. So these things cannot be neatly cut out. You cannot say that we rely entirely on global supply chains. You have to be having some amount of that activity happening in India where you're learning by doing, participating in it, irrespective of the resilience aspect of things. And in this context, let me say that people are unnecessarily pessimistic about our capability of competing with the world. After all, if I took you 10 years back and asked you, why isn't India's manufacturing doing very well? What are the things you would have told me? You would have told me our infrastructure is not up to speed. No longer the case. I mean, the intercity infrastructure is now world class, and we are now investing in the intracity infrastructure. I mean, you don't have to take my word, just go to a tall building in your own city, you'll see cranes everywhere. In fact, you're having to suffer the dust pollution from all of this every day. So you're literally breathing the transformation. So similarly, bureaucracy. I'm not saying that there isn't a problem still, there are pockets of problems, but miles away from where we used to be. And similarly, our industrial capacities are not, poor. There are areas where we are actually world class. I mean, in pharmaceuticals, we are world class. In automobiles, we are world class. There are parts of electronics where recently we have become world class. So why do we beat ourselves up and not think that we can compete? We can compete. We can even compete with China. But we need to scale. And for the first time, we have a few things in our favor that will allow us to scale. One is that post GST, we actually have an internal market. Okay. Before that, we were actually a whole bunch of small markets. But now with GST, we basically signed a free trade agreement with ourselves. So that is one. Secondly, there is genuinely effort to move away from China. We should take advantage of it. And, everybody says, oh, but what about Bangladesh? What about Vietnam? Look, they are not in the same game. These countries are tiny compared to us. The FDI that is going into those countries is a fraction of what comes to India. So we are not competing with them. They are friendly countries. We wish them well. Let them do well. But we shouldn't get caught up with, disheartened because, some t-shirt garments company decided to go to Bangladesh and not come to India. Yeah, we should compete. But, we've got bigger things to chew.
No, obviously, I think a lot of such big things we are visible now. And I think in the banking industry also we are seeing such activities being taken up. Time is up, but we take some bonus minutes and I would like to open up for the audience. Please.
This gentleman here, if somebody can get him a mic, and there's a gentleman at the back, yeah. Let him speak, he's got the mic and then we'll get it to you.
Yeah.
Yeah.
So thank you, sir, for this. Thank you for this wonderful interaction. The question I have is, when the country grows, at the same time, we have huge economic disparity. And that can hit our social fabric. How are we going to address that? Because that has got to be recognized and dealt with at this point of time. Otherwise, it can, hit us back. That's my question.
So, look, when there's rapid economic growth, there will be some disparities. So there needs to be methods that we have in order to provide some amount of redistribution, and as well, separately, safety nets. Both of these things, if you see, we have put in efforts. So one is, what are the kinds of disparities there are? One is in one place, the disparity. Other is the horizontal disparity across the country, and I'll talk about both of them. See, the vertical disparities, as you may have noticed, this government's thinking is about, the idea is not so much the Western idea of inequality, but the idea of Antodaya, which is basically how to help the last man in the line, right? Now, this is a concept of absolute poverty. And this has to be directly dealt with various schemes that this government has done, whether it's DBT or providing direct support with food, or provide direct support with house building, like the Prime Minister's Awas Yojana, the toilet building scheme, and so on. So one is, since we are not socialists, our purpose is not to, talk about, oh my God, there are all these billionaires, it's a bad thing. That's not our problem. India has 1/6 of the world's population, we should have 1/6 of the world's billionaires. That's my view. Our thing is to tackle absolute poverty. And you can see that we are doing that in multiple ways where we directly target the areas where we make sure to give the poor a basic standard of living, a leg up in the ladder, so that they can climb that ladder themselves. So it is very much in our head is direct intervention, make sure we remove absolute poverty and provide a system of opportunities for that person to climb. Hence, again, the importance of keeping growth going, because I don't think there's any such thing as jobless growth. If you want jobs, you have to have growth. It is a necessary condition. It's probably even a sufficient condition if you keep compounding it long enough. And along with it, you need to keep skilling. You need to keep, create financial systems that allow for financial inclusion. All of those things, now you can see where it comes from. It comes from this general idea of Antodaya. So this is the idea of vertical inequality problem. We also have a horizontal inequality problem, which is perhaps even more severe, in some ways more difficult to deal with, which is that the eastern half of the country is distinctly poor from the western half. The political rhetoric goes on and on about north-south divide. In fact, India's problem is not a north-south divide. The problem is an east-west divide. The eastern half, clearly, particularly states like Bihar, Jharkhand, Chhattisgarh, West Bengal, and so on, that whole club, that part of India is now distinctly poorer than the other parts of the country. On any, not just income, on any socio-economic parameters, they will look poorer. And they are still growing slower. So not only are they poorer, they're also not growing. And there has to be a big effort to do something about this. We actually know the solutions to this. One is, first of all, lay out the basic infrastructure. This has to be done. And even within a state, you can see that happening. Eastern UP used to be considered a basket case till very recently. Or Madhya Pradesh laid out the highways, created the airports. Right now, we are creating airports in places like Ayodhya. Just see the kind of energy that suddenly gets unleashed by this. So we need to create the physical infrastructure. But very importantly, we need to think of one urban hub at least, one really big urban hub that begins to generate the very high rates of growth needed to trigger that area. Because in every other part of the country, in fact of the world, growth happens in a very uneven way. It is ultimately a few urban hubs that generate 90% of the growth. The rest of the lot get pulled in. So in the north, you have Delhi NCR. And by Delhi NCR, I mean really the wider NCR, going all the way through to Jaipur and Chandigarh. It's a big, big area. In the west, you have Mumbai, Pune, Ahmedabad, that triangle. In the south, you have Hyderabad, Bangalore, Chennai, that triangle. So even in the south, growth is not generally spread. It's a few places that are generating disproportionate growth. In eastern India, unfortunately, there isn't such a growth driver. It should be Kolkata, but Kolkata has been stagnant now for half a century. It's my hometown, so I feel unhappy about this. But it's the truth. And I'm not talking about the state of West Bengal. I'm specifically talking about Kolkata, the city, and the economic industrial hub around it, which has basically been in decline for now half a century. And the inability of Kolkata to generate extraordinary growth means that the linkages through to Patna or Ranchi or Bhubaneswar aren't kind of generating that kind of dynamic that you see here in Bombay, Pune, for example. So that is the real problem. In fact, the failure of of Kolkata is so bad that there is actually now increasingly closer links between Patna and Bhubaneswar to Delhi, which is much further away than it is with Kolkata, which should be the natural sort of growth engineer. So at some point in time, we have to think about how to get Kolkata back. And that will be an important part of getting Eastern India going again.
Thank you, sir.
Yeah. Question here.
We'll take one more question.
Breaking the mold, if I may say, in terms of your example on semiconductors. My question was, everywhere we see all the vectors which are in the positive direction. Inflation is down, NPAs are down, and you couldn't have asked for a better markets. But what could go wrong? Let's say, three things which come to your mind that, okay, you need to sort of keep the attention of the policymakers that, look here, folks, we have been there before. Capital cycle has been there before. We have seen this demand before as well. Infrastructure has been there before. So what should we do different this time to make sure that we don't end up there again? Thank you.
So, those of you who read my writings will know I'm a complexity theory man. And one of the points about complexity theory is that we are extremely skeptical about the ability to foresee the future. So if I am skeptical about forecasting the future, what do I do about all these things? But let me say that, look, no matter how good I was at forecasting, in the beginning of the year 2020, there was no way on earth I was going to forecast that COVID was going to basically lock us down and the world economy for 2 full years. So that's why, we complexity theory people have a different view of dealing with uncertainty. We don't really care about risk, we care about uncertainty. So how do we deal with this? So our view is that don't bother about trying to forecast what could go wrong. Anything could go wrong, and everything will go wrong. Some war will happen, something bad will happen, climate change may turn out to be completely different from what we thought, and so on and so forth. The more important thing for us is to, rather than waste our time on forecasting, we spend our time on resilience. That is why we are macroeconomic conservatives. Now I hope you understand why, even at the height of COVID, we didn't go out there and blow up our monetary and fiscal resources. Because our view is, at every point in time, things can go badly wrong. Always retain enough ammunition. So the same reason we were cleaning up the banks, we were insistent on doing so much effort on capitalization, so insistent on retaining of such huge foreign exchange reserves. Many people think that, why do you want such huge $610 billion worth of foreign exchange reserves? Because if you're dealing with a complexity theory type thinking, you're always afraid that something is definitely going to go wrong, and I have no idea what. So I'm going to retain large amounts of buffers in the system. So we are big believers in buffers, and very rarely will go out on a limb. And so even in the height of COVID, we remained very, very conservative about using up our fiscal resources and so on. I mean, many people thought that that was an opportunity, in fact, to open up the banking system in the way we had done in 2008, 9, 10. Totally refused. We'll take the growth hit in the short run, because in the long run, our entire thinking is based on the idea that, look, create as many buffers in every direction you can imagine so that you can run them down when some unexpected thing will happen. And we don't waste our time trying to guess what that unexpected thing will be, because it literally could be anything.
I couldn't agree more with you in terms of buffer. I think the convergence of idea of creating buffers in the minds of government, in the minds of regulator, and more importantly, Mr. Sanyal, let me tell you that we at SBI also believe creating the buffers. I think we've been focusing essentially on creating the buffers. As you say, it's very difficult to foresee and forecast what can go wrong. And the resiliency, what you mentioned, obviously resonates well with us, because the theme of the conclave itself is building resilient brand India amidst global uncertainty. Thank you very much for your time, and I think it was invigorating. A big round of applause for him. Thank you. Thank you.
Thank you for that session. I request that you please stay on for just a minute, and Mr. Khara can please hand over the shawl and the green certificate. All right, that was a very interesting session, but it is time for us to now move on to our next panel discussion. This is going to be all about the world of artificial intelligence. We were talking about this yesterday as well. So let's get on to our next discussion right now. Artificial intelligence has become the buzzword this year. It is poised to disrupt our world and presents to us opportunities to complement and supplement human intelligence and enrich the way people live and work. India, as one of the fastest growing economies in the world, has a big stake in the AI revolution. Humane AI aims at enhancing human capabilities and addressing several challenges that we face today. It has far-reaching impacts as well and can be used in multiple sectors. And of course, the banking industry, of course, would want to get on it too. With that set up, our next panel looks at the humane AI, innovations and digital solutions for the AI-dotted future of financial services. With that, let me invite all of our panelists onto the stage now. We have Arya Kumar, Dean of BITS Pilani, Pura Ghosh, Decision Sciences and Center of Public Policy at IIM Bangalore, Bikramjeet Chaudhary, Global Head of Advanced Analytics and Data Science at Datamatics, Aishwarya Jaishankar, co-founder of Hyperface Technologies, as well as Nitin Chugh, DMD and Head of Digital Banking at SBI. Also, of course, Ritu Singh, the moderator of this panel. Ritu, it's all yours.
Am I audible? Wonderful. Thank you again for being here, and that was a tough act to follow after Mr. Sanjeev Sanyal, but we'll try because, like Pavitra introduced, this artificial intelligence is the buzzword. It is impacting all sectors. I mean, who could think that you no longer, banks have been evolving with emerging technology, right? But the last couple of years have been particularly exciting with generative AI and whatnot. We all think we're experts now pretty much, but we'll leave it to the real ones. And so this distinguished panel, we hope, will answer what the innovations and digital solutions for an AI-dotted financial services future will look like. So all of you, thank you very much for being here. And Professor Arya Kumar, if I could start with you. To start by laying out the context of where India stands as far as our artificial intelligence capabilities are concerned. We just heard, Mr. Sanyal talk about how this is India's decade and the decades to come, and we must make the most of this opportunity. So where do we currently stand, whether it is talent, whether it is workforce, where does our advantage lie?
Yeah, thank you so much. I think AI is going to play a very critical and vital role as far as the technology and its implications to the Indian economy are concerned. We've been talking about becoming third leading economy soon in another 3 years or so. And technology. Today we say mobile technology, mobile people, mobile money, mobile banking. And in all this, the core part would remain technology. We are moving fast. When I look at the Indian economy today, as far as the skills are concerned, school level, students are talking of AI. The college level, they are in a big burst in terms of AI-driven startups coming up. Ernst & Young, as well as the other major reports which have come on a skill set as far as India is concerned, the AI factor as far as acceptance is concerned, we are moving very fast. As far as the research and academia is concerned, we are the fifth largest as AI is concerned. We need to put in a lot of, I'll say, further effort. Although Niti Aayog has come out with the research leading to almost 10,000 crores of investment in AI-driven technologies, but still, on a research front, I would say we spend almost just 0.7% of GDP, which has to go up if we really would like to make use of this opportunity at this point of time. So I'm sure that we are ready for moving ahead very fast. Skill set is ready with us. the deep technology, we need to do much more than what we have been doing today, and the research-driven investment, be it the banks, be it the industry, be it the research institutions, be it the academia, all have to join hands, and therein the major push in terms of a research, which is a purposive research, which is a research which is giving a direct impact on a GDP, has to happen. Thank you.
No doubt, and you spoke of collaboration as well, and you spoke about the need to build that skill force. Let me ask the other academic mind on the panel here. When you think of a country like India with its diverse opportunities and challenges, both for a 1.4 billion strong population, what to your mind is the best possible integration of artificial intelligence in the field of finance? Because for a vast segment of the population, even to this day, financial inclusion, real financial inclusion remains a challenge. So what could artificial intelligence do to change the game?
So artificial intelligence can do a lot of things, but whether it will be done in India in next decade, I'm a bit pessimistic. Technologies-wise, we have done huge, but AI and technology are two different things in a way. So technology-wise, we have done UPI, is like, fabulous job. We are the leader in the world. But AI needs data and algorithm coming together. And this is where we are lacking, and the way that our structure is right now, it will lack probably in a big way. But there is a lot of scope. So already UPI, if you can see, it's increasing the credit growth, even the financial inclusion, the fintech companies, the payment revenue-based financing is increasing a lot. So it's getting there, and it will continue to do so. But whether we'll have an exponential push through AI, I'm not so sure.
But what to your mind, sure, we'll take some time getting there, but what is the best possible integration of AI into the world of financial services today that could unlock opportunities for a country like India?
So the major obstacle we have is two or three. One is, if you look at the US market, the best brains of AI are actually in the industry. And industry creates the major innovation mainly because I can create an algorithm, but I don't have enough data to train. That's where Google, Facebook, Amazon get the lead. India is still enormously lagging with the collaboration of industry and academia. So for example, if I approach a bank today, like Chase Bank has done in US, Wells Fargo has done, what they have done, they have basically anonymized the entire data for last 20 years, and any researcher can come in their server and test their algorithm, and they can do a lot of things. So this kind of environment, unless this comes, and I can create an algorithm. Does it work? I don't know. And that's where the major problem is. At the same time, the financial sector sits on tons of data, and for them, because they are bogged down in so many day-to-day stuff, for them to innovate is very tough. So the marriage somewhere has to happen.
Well, let me ask the gentleman sitting next to you from State Bank of India, is it that tough really, to integrate technology into banking? What has State Bank of India been doing in the last couple of years when this generative AI has come about? When we think of generative AI, we immediately think chatbots. But the application surely is much beyond that.
No, let me first say that I don't completely agree with Professor Ghosh here, because yes, algorithms are easy to develop and any data scientist can do that. Training the models requires data, like he said, but the data is now available in abundance, largely for the fact that a lot of data gets generated, much more than what we've generated in the preceding all the years that data has been generated. So there is enough and more data. We just have to find a way of making use of that data. So in SBI, the way we are looking at generative AI is, first of all these large language models on which generative AI is based, or vice versa, whichever way you look at it, most of them are offshore. They are not in India. Now we are seeing an emergence of LLMs in India. You interviewed Bhavesh also the day he announced, this.
Well, those
LLM
are at very
model.
early stages, yes.
Very early stages,
yeah.
but so I do agree with Professor Arya Kumar when he says that deep tech has been missing in India. So we have really lacked a lot of research and deep tech related work. In SBI, what we started to do was analytics, yes, we set up quite a few years ago. The data science practice evolved to substituting and replacing the statistical models which were developed by statisticians by AI models which are developed by data scientists, because we don't have any dearth of data. So we have enough and more data to train our models, to make them work. And we also managed to come up with a framework to make sure that it works within the guardrails of being responsible as far as the AI is concerned, also making sure that it is ethical, it is inclusive, it doesn't have biases, it doesn't have this whole notion of concept drift, that it intends to do something, but over time, the concept starts drifting and it starts producing another set of outcomes like what the deputy governor and even the governor in the IBA conference highlighted, that don't excessively depend on algorithmic lending. So we keep calibrating and recalibrating. Now the way we are looking at generative AI is that one, of course, from the point of view of cybersecurity, which I'm sure we probably might be discussing here, but because these models are all offshored, we don't have too much of a source code in India. The best thing that anybody can do today is to only run some use cases, led POCs. But in the medium term, at least our aspiration is, one, for the fact that we've invested early on into analytics, data science, and AI. And in fact, one of our models already has a patent, an AI model for fraud detection. And we have multiple such models, which are performing very well. One of our aspirations is to actually develop our own large language model, which is specific to banking domain. Why depend on ChatGPT? Why depend on somebody else's?
So is SBI building their own SBI GPT?
We aspire to do that. We aspire to do that. We aspire to, like Bloomberg GPT you're familiar with. It is a domain-specific GPT. There is another, set of GPTs which are domain-specific. So why should we just worry too much about, ChatGPT writing poems and essays and all of that? We could, with our set of data, I'm sure we can develop our own large language models. And to that extent, what we did recently, we have partnered with IIT Bombay. We have set up a Center for Data Science and Analytics, where the primary charter for us is to research, train, and also work on very specific use cases around generative AI, but eventually build the skills to write and develop our own LLMs. Well, this will come. I'm not saying that this is a plan, which is already there, but this is an aspiration that we do have, that eventually we should in-source. And one of the risks with AI that we very clearly see, and that is a problem that we solved long back in SBI, is that all of AI talent is in-sourced. We don't outsource anything, because you don't want anything to go wrong with your data security controls, privacy, and of course the new norms that we are seeing now.
Hearing how much SBI is doing on the AI front, I wonder why the Deputy Governor this morning was commenting that, often IT budgets are going unutilized at banks. And
not for us.
Not for State Bank of India, just to be clear. But Dr. Chaudhary, given that you work with a whole host of industries, banking in specific, what is the extent of, the integration of artificial intelligence into day-to-day financial services activities? Mr. Chugh was just telling us about a few of them, but, are all banks as advanced as what some of the work that he's outlining they're doing here?
Yeah, sure. So before getting specifically into banking, in the corporate environment, your first question was that how critical is AI, right? So we foresee that going forward, there will be two types of companies. Those which will embrace AI completely and those which will be out of business. So it is that paramount and it is that critical, and there are no two ways about it. Now, coming back to the questions of the limitations that may exist, right, today, as was being talked about by some of the panelists. So I think with any technology evolution, there will be those limitations. We have gone through those paths, limitations, etc. There also have been hypes. We have seen the Gartner hype cycle. There have been many, many hypes that were created, let's say big data. There have been quantum computing. There have been so many other things, right? Some of them really took off, some of them didn't. But this particular aspect of AI, and why, for example, AI is being talked about so much. AI is not something new, right? It was in the way back in the last century. What is really making the difference? The differences are coming in the form of, now we have abundance of data. and varied structure of data, structured, semi-structured, unstructured, different velocity, different formats. So the data is available, computing power is there, and hardware is not that expensive. So it is not so insurmountable to really build AI capabilities, which used to be the case in the last century. So fundamentally, things have not changed. What has changed is the ecosystem, the infrastructure, some of the peripheral developments, which is facilitating the growth of AI as a technology and as such. But what are the prerequisites, as Dr. Ghosh was alluding to? If you take a step back, some of the real stalwarts in the space, like Andrew Ng and all, they are alluding to a fact that sometimes we might be putting the cart before the horse. What does that mean? That we may not necessarily have the right data ecosystem. And by that, what is meant is whether we have connected data, whether we have high quality data to support really addressing business problems, right? Because eventually it is garbage in, garbage out. You may have the best ensemble model under the sun, but you may not necessarily be able to conclude, infer as decisively if the quality of data and their interconnectedness is not really established in the right way, right? So hence, while the progression on the algorithms and the LLMs will have to continue to happen, for addressing specific use cases, the foundational models will need to be up-trained with specific data sets which have to be of high quality. That's really the crux, right? So even if you are taking the big LLMs, and I'm not sure I was reacting to SBI developing its own LLM, very ambitious, and whether, no, congratulations, you're thinking on those lines, but also whether it's really that crucial, right? Meaning, at the end of the day, there are, even if, let's say, we are talking about ChatGPT 4 Turbo, the types of plugins that they're creating, and I'm not talking about only the ChatGPT 4 only, the types of plugins that are being created by Google, Bard, by the Geminis of this world, and the Turbos, and the connectedness that can get introduced with a lot of fintech products, give you a decisive advantage in being able to make some early inroads. Because at the end of the day, investment will come only when success are being seen. So some of the low-hanging fruits will really need to be tapped, right? So I think it has to be judiciously thought through from a strategy standpoint. From a BSFI application standpoint, I think, see, BFSI as an industry has been always, what I've seen, have been one of the pioneers in terms of data-driven inferences and decision-making. BFSI, telecom, healthcare, right? Unlike some of the other sectors which are catching up, like the industry, logistics, and all that. So, it's not that the introduction of or higher cultivation of AI and embracing it are going to necessarily change a lot of use cases, but will be able to address some of those use cases in a most prolific way. For example, taking the point that I was mentioning, some of the statistical models, quote unquote, are getting replaced by some of the more, let's say, more refined predictive analytics oriented models, right? And even though some of those may be machine learning based models. Now think of taking it another level, more deep learning oriented models. If you inculcate, you will be able to improve the efficacy, goodness of fate, etc. in a much better way, right? So that's really should be the thought process. In addition to taking some of the best cross-industry practices and experiences, right? Like, for example, even in the Gen AI space, given that we are no more interacting only on text, we are being able to interact with videos. We are being able to interact with images. These are the inputs. There are lots of opportunities that really get opened up, not only for healthcare, not only for education, not only for manufacturing, but also for the BFSI sector as such.
Well, that was a very well summarized, thought there. But, let me just step away from the academia of it and into the implementation, Aishwarya. Cards, credit cards as a service, it's an interesting concept that, the industry that you're in, at a time when Indians are increasingly moving away from cards. So this digital aspects of card, how well is the population responded to it? Are there certain segments that are, more positively reacting? Or, generally, what's been your sense in the adoption and the future of this industry?
See, to me, while we started off as a credit cards as a service platform, the power to us is credit accessibility, right? A transactional credit line in my mind is far more powerful than lending to you at your behest every time you come. From a servicing point of view, from an underwriting point of view, from a credit appraisal point of view, it's extremely tedious. And as you go to the bottom of the pyramid, right, it becomes far and fabricated in terms of distribution for you to come up with the right models to lend at scale, which is where transactional credit can be very powerful. So credit cards itself is a very fascinating case study in India. Ritu, barely about 3.5% Indians own a credit card. Now you compare it to any developing market, you don't want to say US because US and credit in a word don't go together too well, but even a market like Japan, right? There is about 3.7 credit cards per user. Come back to India, yes, UPI is a fantastic form factor, but what we are excited about is UPI on credit. Can underwriting be powerful enough to give your Adobe a line of credit, give your milkman a line of credit? Because often, economists are all here, so I'll be swinging to the choir. In every developed nation, structured accessibility to credit is a very important part of economic development, and that's what transactional credit can drive towards. We're talking about AI here. To me, AI is an outcome of data. And today, as Sir rightly said, India is sitting on piles of structured data. 10 years back, we didn't know who were opening bank accounts. We didn't know who were immigrating into this country. Today, with Aadhaar, right from benefits distribution, right from your bank account, hell, even your SIM card, right? Everything, there is data sitting over there. Now, the conjunction of this data, how well can you use it to create credit accessibility is the real question. A product like UPI alone, how well can it be mined to give a powerful credit line to every trader, every small business owner or a SME in the country, are all the real questions that we would love to be answered with AI. Coming back to credit cards, it is somewhere a lifestyle-driven product, huge amount of data, even within the credit cards that are in the market today, 120 million cards, give or take 3 or 4 transactions a month. Something as simple as risk and fraud, right? AI can play a huge role. How do I show the right offer to you at the right time? That's another place, because these 3.5% Indians are the ones who are booking tickets in airlines. They are the ones who are buying subscription products. They are the higher end of consumption data for the economy, right? And that somewhere is the fulcrum of consumption-led GDP. So with that data, how can we sort of help from a credit cards as a service, from building models, building digital experiences is all that we focus on at Hyperface. But like I said, the core of it will be credit accessibility and transactional credit, Ritu.
And let me pick on what you'd said earlier, only 3.5% credit card penetration, and that is a dismal number for a country of 1.4 billion people. Using artificial intelligence, do you think, are there ways, are there innovative solutions that are emerging to make it a more widespread, more, bring more deeper penetration of credit cards in the country? If you could give us any use cases or any instances, examples that you've seen where it has worked to deepen the presence.
So we are a credit cards as a service company which helps banks and co-brands create fantastic credit card experiences. Amazon, ICICI co-brand is an example I would love to pull out for all of you. The Pay Later program of Amazon and the credit card program of Amazon, there is a lot more data beyond the typical salary data that banks used to underwrite. And interestingly, in the last 3 years since Amazon ICICI card launched, what ICICI did in 6 years, this partnership has launched as many credit cards. Again, this is pure data, right?
Yeah.
Your consumption data, what you're doing in a platform like Amazon, how can I underwrite it better? How can I credit qualify you better? All these are real use cases in my mind that are creating a difference.
I think we're still talking about the very urban metro population that is saturated, with the consumption of financial services like credit cards. But I'll get back to that.
Sorry, Ritu, even for the financial inclusion aspect, as I was telling you earlier, to me, it all starts with the amount of structured data that we have built in so far. Right from your benefit distribution, your Aadhaar related bank accounts, from your first credit into the bank account to the UPI data that's flowing in. To me, the basic needs are models around those, and as you rightly said, are we asking the right questions to the data? That's how AI can come from. Often AI is seen as a panacea for everything.
Yeah.
Today we have a fantastic digital public infrastructure, right? The API stack of India is a pride. To me, we need to have an equivalent data stack or a data access stack that anybody can come in and read to the data, what Mr. Ghosh was talking about. If we can create a very powerful framework to ask questions or the right questions to the data, just imagine the data that an SBI will be sitting on, or an Indian statistical office will be sitting on.
Yeah.
It is about asking questions and building models on top of the data. If a right framework can be created around that, I feel it could be very powerful for a nation like us.
No doubt we have plenty of data, and like you said, asking the right questions to get the right answers is critical. So, Professor Kumar, let me get back to you on that point. Lots of data show that we're working around with, and this proliferation of artificial intelligence into various aspects of financial services, where we're not just talking about chatbots, we're talking about credit underwriting, decision-making, interventions. How do you ensure that bias stays out of it, and we're getting the right output, and that data bias is not leading to certain segments of the population being excluded from being given access to credit?
See, we are sitting on a huge database today when we talk about financial sector as a whole. Now, 4-5 key issues which have to be taken care of when we use AI is the computing power as the one. Having a huge data doesn't help unless you have a high frequency computing power. Second, as Mr. Ghosh was mentioning about the biases in the data. Having a data is the one thing, unless I have got objective data, which can give me a worthwhile decision-making processing, it's of no use. Third major thing which has to be taken care of is the ethical issues in the whole of the AI, which is a very, very vital aspect today. And until the ethics part of it we are very clear, I'm sure, I think, again, the data processing doesn't help me. It would give rise to wrong answers to me. Today we say 60% of the companies are using AI, but 80% of them are using incorrectly because of all these intermediate problems. So my privacy is one, biases in the data is another, computing is a third. Above all, the ethics part would play a very, very vital role as far as the whole data is concerned. So I would say, he was also rightly saying, that today a lot has been happening in terms of AI applications. The major challenges which are there with the banking system today is, should I collaborate, should I take over, should I develop my own? And all these three issues are inbuilt because of the ethical as a one, security and the privacy as another. And I would fully agree. Without compromising on the security, if I have to develop my own systems like I have developed in the past, by having subsidiaries, be it a merchant banking subsidiaries, be it a mutual fund subsidiaries, be it venture fund subsidiaries, all these were developed with the banks because they never wanted to go beyond taking a particular risk. Now when I talk of collaborating in terms of integrating my back-end and front-end systems, I have to be very, very clear that what kind of a risk technologically I am taking. If it is worth for me to invest in a technology as well as the high-end skills, I should do it like a multinational banks. I should not compromise on that. Coming down to Professor Ghosh ideas, I would say we have good coders in India. We have a good algorithm writers in India. They have been playing a very vital role as far as my unicorns from a US are concerned. But computing is certainly a challenge for us. Data privacy is certainly a challenge for us. So I would say my AI applications have to be handled in a very, very sensitive way. And if I take a wrong route, it's going to give me a wrong answers also. So my all models, as was rightly said in the morning also, have to be very, very dynamic with a full protection inbuilt into the system. And until that is put in a place, I'm sure the AI would not deliver me the kind of results I'm looking forward for.
Professor Ghosh, because he constantly referred to you, I'm wondering if you wanted to chip into what he had to say.
No, in general, right, so 2-3 things. Right now, in India particularly, I don't say we are actually doing artificial intelligence. What we are doing is a very sophisticated, some amount of intelligent automation of the systems. So that's where we are. In the fintech space and in the financial sector in India, they are way ahead of the curve in generally because like SBI did and some other banks did and the fintechs did, they've invested way ahead. So they are ahead of the curve. But still, we are a very big user and we know how to scale, but we are not innovating. And that's what the problem is. So for example, in credit card, after a long time, I found a very innovative product, which is BNPL, which uses a huge amount of, alternative sources of data to give you credit on the spot. Now, that's a very perfect use of, let's say, AI for financial inclusion. But then the moment data privacy comes in, it goes against the financial inclusion, actually. So we have seen in research that data privacy and financial inclusion doesn't go hand in hand. It actually, because if I don't have the, let's say, tax data, I don't have any other sources of data, it's pretty much you are being able to give me loan based on my call logs, based on my revenue stream. And if data privacy comes and says, no, I cannot share call logs, then what does the bank at the fintech company going to use to figure out my risk profile? And that's when the salaried people doesn't get hurt, but the lower part of the pyramid get hurt because they have to give something. And so there are quite a few research now which shows that data privacy and financial inclusion doesn't go hand in hand.
But Mr. Chuk, I wonder if you'd want to respond to that. That's quite interesting, coming at a time where you also have the Digital Data Protection Bill, where it's going to become even more complicated for you to use customer data, and you're talking about crores and crores of your customers, and with artificial intelligence, we're talking about biometrics, facial recognition. I mean, we're talking about all kinds of privacy being in the hands of banks like you. Do you think that's going to be a challenge?
It is going to be a journey that we'll have to go through, but I don't think it is a challenge that cannot be addressed.
A challenge for financial inclusion,
No,
like Professor Ghosh
I
said.
think financial inclusion has been, financial inclusion is not something that we will have to start after the Data Privacy Act. Financial inclusion has been going on for the last 70 years. And today we are at a level where, especially with things like micro pensions, micro insurance, India is probably at the highest level of the developing countries in terms of just the penetration. Right? So, and I'm not even talking about bank accounts. That is a problem that has already been solved long ago. So when you look at credit as the only remaining part of inclusion that has to be provided to the bottommost excluded variety, in the absence of data that would have otherwise come from let's say bank statements, and because everybody has bank statements, everybody has started using digital payments in some manner or the other. Yes, the UPI bandwagon is also expanding. It is growing beyond the 300 million to 400 million, and it is expected to go to 500 million in any case. So there is data which is coming in which is reasonably pure. So I don't think it is going to be only necessary to look at some of the surrogate data. And even if it is going to be necessary, I don't think it is going to be a problem of asking for consent in a responsible and ethical manner. So we just have to be sure, and banks have been doing this for a long time. I don't think any banks will mess around with taking consent unwillingly from customers. And therefore...
Then you'll be in violation of the law.
Exactly. So even while the law hasn't got notified as yet,
Not yet, yeah.
in our assessment, I think we'll be compliant right from day one with whatever provisions that the law, is expected to come up with. Because we have been practicing some of that, and I can say this for almost the entire industry, that taking consent from customers has been in practice for a very long time. The excluded lot, like Professor said, yes, there is going to be a process that will have to be followed. But because they have a bank account, because they've started making payments, increasingly more and more digital payments, the access to credit problem will also get solved. And if at all we need any additional data in terms of, let's say, call records or whatever else location data, that can always be obtained with consent.
Aishwarya, I'm wondering, as someone who works with data, near constantly, do you also find that a challenge?
I think I totally agree with what Nitin was said. See, the point is when it comes to data, right, we often tend to club it all into one group. What the customer is really worried about is the PII. And, my age, my location, my gender, and my mobile number and email are sacrosanct. If you were a bank and you're going to tell me, hey, you know what, based on your consumption pattern, I'm going to tell you certain offers for you. Or it could be that I'm going to recommend certain banking products for you. By itself, it's not problematic to the customer. The problem is the way it is being articulated and the way it is being sensationalized. Your data is going away. It's not going anywhere. It is sitting very safely within the bank's safe, secure servers as per RBI specifications, and rules are being run in an aggregated basis. Let's remember that. It's not just for one customer. It's for 1 million customers that the data models are being run. I feel as we talk more about AI and data privacy, educating customers on the power of data should go hand in hand, because we are seeing this in payments where the payment engine has moved so fast, but customers are still getting defrauded. Because educating them, I feel, has to go hand in hand, especially the PII data segregation from the data that can be modeled.
Sure. I mean,
just pitch in quickly. So with the concept of open banking becoming more and more strong, consumer feeling that it's my data, not bank's data, not fintech's data. And that's going to change the game, because as of now, our financial institutions kind of think it's the financial institution data. But open banking basically mandates, and they will down the road, that, as long as customer wish, anybody can get a pie of that data. And that's going to change the game.
An account aggregator is exactly that.
Yeah.
I'm going to give you consent to use my data for X, Y, or Z purposes. But, let me step away from it. And Dr. Chaudhary, I see you nodding. I wonder if you wanted to add something. Because
to react on this thing.
Yeah.
So the reason for having a very clear governance framework at an early stage for a country like India is critical, right? Let's say European Union have now come up with their governance framework.
Yeah.
Not foolproof, not fully insulated, not complete, but they have been the first to move with this. The reason being that there are areas of vulnerability that they recognized very early, right? White House is very active now at a very nascent stage, but open to deliberations. Sam Altrons of this world are actually going out and preaching for and advocating for this governance framework. So India is at a stage where if we can take some of those best practices, start thinking through it. Like, for example, if you look into the European governance framework and the compliance framework, the more you analyze, you will realize that it is still a little bit broad-based. The more debates and deliberations are going on, you will recognize that these governance frameworks will have to be far more sector-specific.
Yeah.
Because the nuancical elements of the sectors play a very, very major role.
Yeah. And like Minister Rajiv Chandrasekhar said, no more warm and fuzzy words. We need specific outline guardrails.
Correct.
But, if you're touching about the ethics aspect of it, let me ask the professors next to you, if you're building that into the curriculum already, governance, ethics, ethical, responsible use of AI when you're teaching it to your students, what is the importance that is being assigned to it at that level?
See, I would say, so the academic domain is concerned, ethics have to get integrated in all aspects. AI, not only AI, because anybody cannot go in terms of a marathon unless he is ethical. So ethics has to become part and parcel. And today when we talk about Howard talking about the Gita and management, there is some reason for that. that ethics have to get integrated everywhere. But more so, you see, in a technology domain, if we don't have an ethics, then as Mr. Ghosh was rightly saying, governance becomes very difficult to look at. Suppose there is a selfless driver-driven car and it meets an accident. Suppose tomorrow a major fraud happen in a banking industry. Whom to hold responsible? Unless we have a governance in a place in terms of checks and balances, we are talking about collaborating with the partners.
So how much emphasis do you lay on that aspect of the use of artificial intelligence in curriculums, in colleges, to prepare the workforce for the skill gap that we have in AI?
We in our institution, as BITS Pilani is concerned, let me tell you, some of the courses which are becoming very popular today are from humanities and psychology. Cognitive sciences and the basics of the ethics. Gita and management is the one course which has become very popular, around 500 students are taking. And surprisingly, last semester I was looking at the data, one of the Christian girl student topped that particular course. So these are something which are very miraculous things which are happening, that the students themselves taking greater interest in terms of integrating the computer ability with the finance, with the humanities. Another great thing which have been happening in a BITS Pilani is, because of minor programs today, every computer science student is taking a finance as a minor, and then he does a CFA. Because they look at the opportunities in a financial sector to be far more lucrative with a technology background.
Yeah.
And then if they do some ethics courses, and ethics and AI as a specialized course, I'm sure he's preparing a well-rounded professional to play a vital role in an industry.
Well, you know, speaking of skills, Aishwarya, when you go out to recruit today, and given that artificial intelligence is so widely being used, including generative AI, a relatively newer concept, do you find the requisite skills that you're looking for in the market, or do you often come back disappointed at the lack of skills, that you're looking for?
Oh, you'd be amazed, Ritu, if I tell you about my APM interviews. They'll be like, I'll answer this question, once I'm done, I'll share a note with you. And it'll be a beautifully written note till you realize that this is a ChatGPT submission. These kids know how to hack things as well, which is where somewhere what he told about ethics resonates. Yeah, they do have skills. Let's not doubt this generation. And they are skilled enough to manipulate the AI as well, is my worry. So the AI might have to be the watchdog as well at some point of time, My 15-year-old son says he goes to ChatGPT to ask for ideas, That's the generation we are bringing up. So ethics needs to be ingrained in the user as well as the AI is how I look at it.
Well, yeah, on a more serious note, of course, none of these questions were prepared by ChatGPT. But let me ask you, Professor Ghosh, since every time we talk about artificial intelligence, we're talking about skills and workforce, there's always that immediate fear that comes in the mind of people, and for valid reason, that it'll threaten jobs. We have one of the largest payment companies in the country that has recently announced that there's been a slight reduction in the workforce because they were able to see the transformative power of artificial intelligence in the use of financial services. How real is that threat, and how large is the skill gap that is needed to be filled to ensure that jobs are created faster than jobs are lost?
So the total number of jobs may not reduce drastically. It's a reallocation, the way I see it. So there are certain kind of jobs will go because we are in the midst of huge amount of automation. But that will create some new kind of job. The major problem is not that. The major problem is we in the academic institution are struggling what to skill the new, we still don't know what to skill, to be honest, because of two things. One, so India did IT, they captured very well because IT is a unidirectional skill set. AI is a multidisciplinary skill set, and Indian academic institutions are notoriously bad in collaboration. To be very honest, IIM Bangalore, IISc doesn't collaborate, right? So that creates a major problem because today, if you look at the top technology firm, they hire as many engineers as economists or as historians, right? So we need that multidisciplinary skill set. So that is one. Second is because our academic institutions are dominantly teaching-based institutions, we are a user. So somebody needs to do the research and then I will bring it to the classroom. And I am not doing that. The US is doing that. China is doing that. And that's creating the major problem in skilling. I'm waiting for the next material to come for me to, because if you look at IIT, IIM, we are majorly teaching institute, not research institute at all. And that creates a problem that what do I skill? If I don't do research on this topic, I have nothing new to skill my students unless somebody else created the material and I can communicate much faster. That's the problem. Like in my class, what happens is when I teach machine learning, a lot of the time students are sleeping. And I don't blame them because whatever I'm saying, they already know that from Coursera or something. They already know. So unless I'm throwing something new for them, it's very hard to glue them in the class. So skilling is becoming a tough choice for us. And the third problem is we also don't know what is coming tomorrow because technology is changing so fast that I'm training something now and next year it's getting obsolete. So I think that today's youth, particularly who are in the age group of not necessarily the youth, around 35, 40 age, where the technology firm started to ask whether I need this guy or not, a constant upskilling is there. And that constant upskilling is not 5 yearly. It's probably every 6-8 months you have to go and reskill because so many new things are coming. And this is a challenge for both for the students as well as for us.
No doubt. I mean, the pace of technology is a challenge for stakeholders, for academia, for industry, for the regulator, everywhere.
Let me just add to Professor Ghosh's idea. This reskilling, learning, relearning, that's a main domain today. I would like to especially highlight, we introduced a work-integrated learning programs in a BITS Pilani in 1989. You'll be surprised to know, today we have 45,000 students, working professionals, while being in the job, pursuing higher degrees. These are the ME programs, they are BS programs, and most popular programs are data science, AI applications. These are the most common programs which most of the industries are demanding today. So I'm fully with Professor Ghosh in terms of reskilling, relearning has to be a continuous process.
Yeah.
Knowledge is becoming obsolete at a very fast pace.
Yeah.
And until we keep doing that with each employee, and that's a major challenge to the banks today too.
Yeah.
We're looking at the technology induction, how fast we can reskill our own employees has to be the greatest challenge.
Well, let me complete this jobs and skilling debate with you, Mr. Chuk. As State Bank of India, as one of the largest employers in the country, just tell us how artificial intelligence has impacted, your employee workforce because of costs and efficiency, improving. I'm wondering if you're going to hire at the same pace, whether you're going to go to an IIM or a BITS Pilani to hire, or are you looking elsewhere to hire? Are you seeing the requisite skills?
See, data scientists, we do hire from the market because
do you go to IIM Bangalore? He says, the students already know everything. He has to keep up.
History.
Not in future.
But I think the way we are looking at AI in the bank is that it still has a lot of headroom available for efficiency unlocks, and that will continue to happen. Business models are obviously also transforming within the bank and in the industry, and as that change takes place, AI is going to go through this whole phase of being an assistive technology, which will improve the efficiency and unlock a lot of productivity gains, to being an augmented technology where it will start supplementing the effort of, let's say, coders or product managers, customer service agents.
Sure.
That can anyway come even as assisted. And eventually, and we are in no hurry to get there, that some tasks will get performed autonomously also. So rather than jumping straight into an autonomous role for AI, we want to go through this whole journey and learn also along the way and keep releasing those unlocks.
It's difficult to predict, but currently, in the last couple of years, what has been the impact of the wider adoption of technology on your hiring pattern?
We're huge. I mean, I'm not talking about our headcount, I think, is by and large, consistent for the last few years. And we do obviously, have the intake of our probationary officers every year, but also because we have a superannuation cadre, every year. But more importantly, I think what we've been able to do is that a whole lot of business benefits, risk management side benefits, early fraud detection, reallocation of resources. For example, one of our models which runs the footfall prediction or footfall analysis in the branches, and then does the allocation of staffing, which is quite standard even in call centers. We've been able to very productively and usefully deploy that to be able to unlock those efficiencies. But I think the largest gains for us have been on the underwriting side, towards risk management, and on the business side.
But no change in your hiring pattern because of these?
Yeah, so we are hiring more and more data scientists now.
No, the hiring is not coming down because of this efficiency that you're seeing.
See, the bank we are in a growing economy, and I think the bank has been doing very well and growing. So I don't think there's any reason for us to saturate at that level and say that we don't need to hire
I
people.
see. Okay, we're left with the last few minutes, so I want quick answers from all of you, starting with you, Dr. Chaudhary, as what you see as the biggest risk and the biggest opportunity in what would be an AI-dotted future of financial services.
Opportunity.
And risk.
Yeah. So risk, let me start with. It's essentially lack of governance and making sure that the right compliance framework is in place, because otherwise, it can become extremely distorted. There could be a lot of deprivation. Inclusive growth could be a challenge. So a right governance framework is really the key. Opportunity, sky's the limit. So if we take care of the real governance framework, then India as a powerhouse can really make huge, huge impact. We have the right skill sets.
Yeah.
Number one, right demographic dividends, right knowledge base. So essentially when we are looking at some of the estimates, right, the GDP can be impacted by trillions of dollars, right? And that's in the foreseeable future. It's not a science fiction.
Okay.
It is really possible to do that, considering the foundational educational background that people have and the ability to diversify into a changing environment, adaptation.
Okay.
Let's say, for example, that when we are talking about skill sets, coding, which used to be one of the most sought after skills, are expected to be obsolete, outdated in the next 3 to 5
We
years.
can use English or Hindi or whatever we'd like.
So essentially, that really means that one has to be really nimble. One has to be really adaptive. Not only the educational system, every individual, right?
Yeah.
And as a society, we are extremely resilient. We can see the workforce. They are being able to adapt themselves, train themselves to be able to gear up for the new challenges.
Okay,
So
Professor Ghosh, if I may ask you, if sky is the limit, what is the parachute we need to have?
Both industry and government need to invest in artificial intelligence. Right now, we don't have it. We'll fail. Majority of the time, any new technology, if you want to innovate artificial intelligence particularly, will fail miserably. But we need to have that buffer from the government research grant or from the industry, to say that it's okay to fail, but unless you fail, you will not. We need to create that environment. Otherwise it will not happen. Just to give you an example, if you go to Amazon, so I'm currently part of it also. So Amazon comes up with a futuristic problem, give it to a school and say, here is the money, solve this problem in next 5 years. You ask them back that what happened if I cannot solve? That's okay. Right?
Okay.
So we need that buffer.
India needs the capital, and hopefully the banks will provide it. Mr. Chugh, the biggest risk and the biggest opportunity in an AI-dotted financial services future?
I think cybersec for sure, and that again at a multi-tiered level. So the first thing, of course, is at a national level, because most of these models are offshore. Till such time that we have onshore our own indigenous models, the foundational models, which now are upcoming, including the cryptography protocols, which are today controlled, very tightly, largely by the US. There is a chance that, like Europe became a data colony, somebody else becomes an AI colony for somebody else. So we don't want that to happen. So that's at the national level that we need to secure our assets, but we need to build, and that is where research is very important. We need to bring in capital for that. We need to bring grants for that. The second level is at the enterprise level. So enterprises need to secure themselves, their perimeter around, when they use and deploy AI, for which, what Dr. Chaudhary said, we need governance. Like I shared with you in case of SBI, we do have a responsible and ethical framework. So at the enterprise level, you create the whole ring fence. Finally, at the customer level, there is a need to educate, like all of us have discussed, and also bring about this whole...
You can
data
win
privacy.
all the technology you want, but if I want to give my OTP, what are you going to do?
That is again a function of, education, that
Yes.
not to be greedy.
Yeah, yeah.
And it's all led by greed.
Okay, biggest risk and biggest opportunity.
To me, the biggest opportunity is with the amount of data this country has and with structured model, a farmer in some tier 3 or very small, unlocatable in a map location who is in need of a tractor loan might just get it at the tap of a requirement. That's the power of what data models and automated AI can achieve if we let it happen. But who's manning the watchdog itself could be a question. So yes, regulatory frameworks are important. I would go beyond to say one is framework and second is regular monitoring, for all the complaints bankers might have on the central bank. Last 2 decades, we have seen how we have grown is because our regulator has been extremely, proactive in bringing things, and that's what is needed in AI, a watchdog body which not just only stipulates what needs to be done, but keeps guiding and keeps creating those guardrails very proactively so that AI is used in the right fashion. I think both are the need of the hour right now for this opportunity to be tapped into.
Okay.
So I'm part of the SEBI committee for developing these guidelines. It's almost impossible to do it.
Why would you say so?
So, say for example, I'm a broker, I used algo trading and it did some bias. Now, how does SEBI do it? How does SEBI knows that it's happening? Because then SEBI has to go back to every algorithm I have created. Or SEBI has to say, you give me all the algorithm before you deploy, then my secret sauce is out.
Well, we're hoping the IIMs and the IITs of the world are going to help us find that solution. So final word to you.
Biggest opportunity today, young India, with the technology focus in terms of 1.2 billion mobiles, 700 smartphones. So AI would contribute almost maybe 15 to 20% of total GDP in years to come, another 5 years or so. And this is the right time in terms of buffers. We talk about the financial sector, we talk about the foreign exchange reserves, we talk about GDP. All sides, we are prepared to take a bold move at this point of time with a young India in a place. The greatest challenge which I see today with the technology is inclusivity and the risk associated with the technology. So my cyber crime, cyber frauds, we'll have to be very, very sensitive to all that.
Yeah.
And that is where I think the ethics would play a very vital role as far as the use of AI in any domain is concerned. And word over, now ethics and the AI centers are becoming far more prominent and dominant as far as the use of a technology in the future is concerned. So I would say it's the right time for India to grab a big opportunity in a global economy with the technology as an inflow, wherein AI is bound to play a very, very vital role. We are ready with the skills. We need to keep investing in a technology. Skilling, reskilling, learning, relearning has to be the continuous process in that.
All right. I think we left for the last 3 minutes, so we could maybe take one question from the audience if someone has a question. Anyone? Okay. Okay, all right. I think everybody's been very well educated by this panel, so thank you very much, all of you, for being a wonderful audience. Dr. Chaudhary, Professor Kumar, Aishwarya, Professor Ghosh, Mr. Chuk, thank you all for your time here. Thank you. Thanks very much.
Thank you to all of the panelists, and thank you, Ritu, as well. Mr. Khara, could you please come on and hand over the mementos? going to say? Like I said, we have a very packed session today, and another very special address is planned for you right now. We're going to invite Dr. V. Anant Nageswaran. He's joining us virtually. Mr. Khara, you'd like to say a few words as well?
Good afternoon, friends. While we are in the 10th Banking and Economic Conclave, the theme of the conclave is building resilient brand India in the midst of the global uncertainties. Very important aspect here is how are we placed as far as the macroeconomy is concerned, and how are we navigating the global challenges. To really give a right perspective, we felt that the right person for this subject is none other than Dr. Anant Nageswaran. So with that in mind, we were looking for his physical presence, but because of his various pressing engagements, he could not make it, but he is joining virtually. We would be very happy his perspective, how he perceives how to build the resilient brand India in the midst of the global uncertainties. Over to you, Dr. Nageswaran. Thank you.
Thank you, Mr. Khara. I hope we are all able to hear me.
It's all yours. Please go ahead.
Yeah, thank you. So, good afternoon, dear participants, and thank you, Mr. Khara, for those kind words. And please believe me, it is my personal loss as well for not being able to join you all in person in Mumbai. Of course, you must have also heard of the fog-related flight disruptions happening here in Delhi, but that's not the reason why I'm not there. It was due to some extensive travel lately and personal commitment that prevented me from making it to Mumbai today. But I hope I can break the jinx next year, and I hope you will invite me, notwithstanding my inability to be present in person on the last two occasions, this year and last year as well. With that in mind, the theme of the conclave, Resilient India Amidst Global Uncertainties, is a good topic because we need to understand what makes us resilient and also what we should be doing to preclude getting into situations where we may have to bank on our resilience to bounce back. Because resilience is all about flexibility and bouncing back from situations of stress or difficulties, etc. So I'll just share a few slides and share my thoughts as well. One of the reasons why the Indian economy has been resilient is, of course, its strong domestic demand component. As one would expect from a typically large economy, we have about 60% roughly coming from domestic private consumption, which shields us from the vagaries of global trade. And also given the fact that our current account is less than 2% of GDP, the current account deficit also prevents us from being vulnerable to the vagaries of global capital flows as well. So I think these two factors are very important at the outset, and that is why India's real GDP growth has been quite strong, although this chart might look as if the red line is flat. That is because we are coming from a very high number of more than 20% year on year in the first quarter of fiscal 22. Otherwise, the growth rate of 7.6% in the quarter ending September is a very good number in the global context as well. And the projected growth rates for the current financial year globally is around 6.5% to 7%. RBI is leading the pack with its projection of 7%, and we have no reason to distrust the central bank's estimate. And overall, the calculation of the potential GDP growth rate of India, which Fitch measures, is around 6.2%, the highest in terms of the medium-term growth outlook. However, we expect the Indian economy to grow on average at around 6.5% in the remaining years. And currently, it is possible to argue that while the economic survey projected a baseline growth rate of 6.5% for the current financial year, and at that time, on January 31st, we said the risks were tilted to the downside, but now it is possible for us to say that the risks probably are tilted to the upside on this baseline estimate of 6.5%, which the central bank captures very well with its projection of 7% real GDP growth expectation for FY24. The Standard & Poor forecasts a wide range of 6 to 7.1% annually for the next 2 fiscal years as well. And Fitch Ratings has raised its medium-term potential by 0.7% to 6.2%, which even then we still think it's on the lower side, because one of the resilience factors for India is the balance sheet strength, and which public sector banks led by the State Bank of India, which they very well exemplify, and that gives us more resilience. We will talk about that later. So what are the factors that are behind the resilience? As I mentioned earlier, we have private consumption dominating at 6% on the right-hand side. Investment is about close to 30%, and export of goods and services making up the rest. And if you look at the growth rates of the 3 key sectors, primary, secondary, and tertiary, we do have growth rates picking up very strongly on the industry side, and then the agricultural sector growing at around trend or slightly below because of the monsoon vagaries in the second quarter, and services sector growing at high single digits as well. So overall, sustained increase in consumption and progress in investment with a high share of domestic consumption giving us the resilience that we are looking for. The other factor that has given us resilience is the way the government and the central bank have managed inflation. Although consumer surveys are picking up concerns with food price inflation in the country, the absence of an open-ended fiscal and monetary stimulus in 2020 and 2021 in India is a very major factor behind India's economic resilience. We did not open the taps in a manner that was unrestrained. We were frugal and prudent and targeted with monetary and fiscal stimulus, and that is why, notwithstanding the seasonal fluctuations in food prices, the overall inflation rate and the core inflation rate are very well behaved. Both the government and the central bank have been proactive in managing both the supply side pressures and the demand side pressures, with the central bank responding to improving growth rates by slowly, gradually increasing the nominal interest rates, and thereby allowing the real rates also to slowly rise above the zero line. So, and the wholesale price inflation, which shows deflationary tendencies in 2023, because of the base effect coming from last year, is also beginning to edge back above zero. So overall, our resilience comes from strong domestic demand, and we are now somewhat slow in remembering, because memories do fade very fast in today's world where things change very rapidly and the context changes very rapidly. India's COVID management for the bulk of 2020 and 2021, despite international headlines only featuring negative stories, the truth is India managed the COVID situation both from the health dimension and from the economic dimension far more realistically than what other countries did, both with respect to vaccination and the deploying of sensible lockdown policies. We did not implement nationwide lockdown after the very first one and allowed local authorities to manage the lockdowns depending on the local context. And I would also mention that in terms of the lockdown policies, the decision after the first nationwide lockdown in March 2020 to allow regional or localized lockdown policies was a very good recognition of the law of unintended consequences and trade-offs. Today, for example, we are reading stories in Europe about lost years of education. No doubt it happened in India as well, but the fact that exclusive focus on COVID and resorts to lockdowns, preventing citizens from accessing other services and also depriving children of personalized touch in education and the social networking skills that schools create. I think that is very important and will cause long-run damage to several countries. And with India actually steering clear of national lockdown, it allowed economic activity to proceed without major disruption. So the lesson that we are learning from this exercise, from this outcome, wherein the economy proved resilient to COVID and its impact, is that policy making must also always take into account trade-offs and the law of unintended consequence. And this lesson we need to apply even in the context of managing our external trade, imports and exports, as well as in managing the prices of agricultural commodities, that there will always be the operational effect of law of unintended consequences, and that policy decisions taken and avoided both have trade-offs. And it is good to keep these two factors in mind, the law of unintended consequences and trade-offs, so that the resilience that we have displayed bouncing back from COVID remains as strong as ever. That is the first lesson to learn, and not only for other countries, but also for India going forward in terms of being able to maintain and sustain the global economic momentum and the resilience amidst global uncertainties. The other aspect which is keeping us in good stead is the fact that India's services exports have proved resilient, although the growth rates have come down, but the imports also have come down, and that is why the services sector trade balance remains in good surplus and merchandise trade deficit is improving. So overall, trade deficit in the first 8 months of the current financial year have been on the lower side compared to the trade deficit last year, including both goods and services. And in general, trade balance in the overall GDP mix is relatively lower compared to other East Asian countries, which makes them somewhat sensitive to global economic cycles. And India's case, while it has definitely become more sensitive than in the past, but in a spatial comparison, India is better off. And while this, coupled with the fact that remittances coming from Indians living abroad has been quite strong because of the boom in general in the Middle East economies in 2022, and also other services sector exports, keeps our current account balance so well within the fundable range that a combination of FDI and FPI flows has been more than adequate to finance it despite the rise in oil prices last year, which of course has moderated this year. And this also has enabled us, these investment inflows and the central bank's reserve management have allowed us to build up foreign exchange reserves to the tune of nearly $600 billion, giving us nearly 11 months of import cover, coupled with the fact that our external borrowings are extremely limited, both in the public and the private sector, and the sovereign in particular hasn't issued any dollar-denominated or hard currency debt. These are the additional factors that support our resilience. The most important factor, which especially in a conclave such as this is important to acknowledge, is the fact that 10 years ago, our banks were overstretched. Our corporate borrowers were overstretched. And a boom that started in the early years of the new millennium became unsustainable because of projections that India would continue to grow at very high rates for a long period. Those hopes were belied after the global financial crisis. Efforts to sustain that growth through monetary and fiscal stimulus proved to be unsustainable post-crisis, and therefore the remainder of the second decade from about 2013 onwards had to be dedicated to repairing balance sheets both in the corporate sector and in the financial sector. In the corporate sector, it meant deleveraging, selling off assets, bringing down debt ratios, and the banking sector, it meant recognition of bad debts, provisioning, write-offs, and that is where insolvency and bankruptcy code also helped and going forward will continue to help. So it is very important for the economy to remain resilient and strong is to make sure that this improved balance sheet stays with us for a long period. That is why the recent decision of the central bank to raise risk weights on unsecured personal loans is like a stitch in time that saves 9 in the future. So I think if the economy were to avoid falling into situations where it has to bank on the resilience, underlying resilience, we should remember the lessons of the first 2 decades of the millennium. I think in general, we tend to confuse aspirations with achievements a little too quickly. And it's important to ensure a long period of sustained economic growth and sustainable, in a financial sense, economic growth before we raise our head and talk about them assertively. In other words, we have to demonstrate the kind of growth performance for a long period of about a decade, for example, if not longer, of at least 6.5% to 7%. Before we can talk about, before we announce our arrival. So it's very important to remember that ultimately we are going to be judged by a performance which is now very impressive in terms of the recovery we have displayed post-COVID, but equally going forward, it has to be sustained and built upon for the remainder of the decade. And in that, the role of the banking and the financial sectors in general is very important, and we have to avoid the mistakes that we made in the first and the second decade of the millennium in terms of over-lending, over-borrowing, and focusing on near-term and short-term growth maximization at the expense of long-term financial sustainability, viability, and profitability, both for borrowers and for lenders. So that is what is going to test our resilience going forward. And if we have to sort of realize our economic potential in the coming decade and beyond, the role of the banking sector, especially public sector banks, is very critical. And therefore, we need to do whatever it takes to incorporate delayed gratification in our business expansion and growth plans as compared to the kind of instant gratification that is very tempting. And therefore, to the extent that internal compensation and incentive plans are suitably incorporating both return, asset acquisition, and risk management provisions, we should do so such that the alignment of management is in line with the long-term interest of the institution and the long-term interest of the economy itself. And the other factor that has sustained our resilience has been the government's ability to ramp up the capital expenditure, which the union government has done demonstrably in the last 6 years. And the evidence of it is seen in the infrastructure improvement that we are seeing on the ground, whether it is in highways or railway stations and railway network, number of airports, capacity in our seaports for cargo handling, etc., as well as in the number of educational institutions that have come up in different sectors, whether it is management, medicine, or engineering and technology, etc. But again, this has to be now sustained by the private sector going forward, which of course is faced with a lot of global uncertainties. But clearly, strong balance sheets, strong operating financial results, and high capacity utilization combined with the prospect of consumer resilience should encourage our private sector to take over the baton from the government going forward in ramping up capital investment in the coming years, which will then convert our economic resilience into one of economic dynamism going forward. And fiscal management, which has been very prudent, transparent, and conservative in terms of assumptions, must also sustain in the coming years, notwithstanding political cycles. And that is what will also enable us to translate our improved growth prospects and public finances into a better credit rating, which will in turn bring down the cost of capital in nominal terms and enable even the micro, small, and medium enterprises, which still face a slightly higher cost of capital, to be able to grow to a size that is commensurate with our economic potential and aspirations. No country has reached advanced country status, high income status, without having a middle stand, a core proportion of mid-sized enterprises, which currently we do not have in adequate numbers and proportion. For that to happen, I think it's very important that the cost of capital comes down even further, and the biggest contribution that the governments across the country, union and states, can do to ensure that is to sustain prudent fiscal management, because ultimately, in the medium to long term, prudent fiscal management is actually fiscal stimulus in the form of a lower cost of capital coming via a better credit rating. And that is also something that will sustain our economic resilience and translate it into economic dynamism. Lastly, I would say that economic resilience going forward will be critically dependent on the way we manage our energy security and energy transition. Our installed capacity still is largely dependent on coal, but renewable energy is catching up very fast. So the strategy is to focus on phasing in renewable energy instead of phasing out fossil fuels, because renewable energy still has technological challenges such as storage and grid stability, etc. But it's important to remember the country is on track to achieving the target of having 50% cumulative electric power installed capacity from non-fossil fuel-based energy resources by 2030. As per the latest data, 43.75% of our installed capacity is in non-fossil fuel sources, renewable energy, hydro, and nuclear put together. And it's important to remember that India has significantly developed its climate actions, resulting in a path to achieving its NDC, nationally determined contribution, well before 2030. It is the only G20 nation in line with 2 degrees Celsius warming compared to its fair share contribution to climate action, which is a verbatim quote from an IFC report released in September 2023. So we are managing energy transition and at the same time keeping one eye on energy security, which is what will help us sustain economic growth. And there it's important that the country actually invests more in climate adaptation and resilience rather than in emission mitigation in the near term, which will generate the economic growth and therefore generate domestic savings that can be translated into investments needed for energy transition. In other words, energy security near term is a segue into energy transition in the medium to long term, because economic growth is a precondition for successful medium-term energy transition. So that is also, therefore, ensuring energy security is an insurance for economic resilience. So, and we have done this through policy and regulatory measures and also through various innovative funding mechanisms. To conclude my presentation on resilience, so we need to remember, if resilience is all about bouncing back, it is even better to be in a situation where we don't have to bank on our resilience, if we can help it. In other words, sustaining good times with prudence, moderation, and tempered optimism, such that good times do not roll into difficult times as has inevitably happened in the past, unless circumstances beyond our control bring them about. It is even better than calling on the strength of our resilience from time to time. In other words, we need to do our best to prolong the good times, because eventually external factors may always bring about a change in fortunes for the worse. But if we are able to sustain the good times far longer than we have done in the past, then the buffers we build for the bad times will be much bigger, much stronger, and the difficult and challenging times will be relatively shorter. So we are currently justifiably basking in the recovery that we have been able to achieve post-COVID in the last 2 years, which has sustained into the current financial year and looks likely to sustain in the coming years as well. That is very good news, but it is important that both collectively, both in the government and outside, individuals and institutions, private and commercial, private and non-commercial, all players in the economy are motivated to achieve economic sustainability and dynamism such that the resilience, underlying resilience strength gets built up. This is as true for governments as it is vital for individuals. In fact, without a productive and healthy population, economic resilience will not become stronger. And there, India has to invest a lot, especially Indians, in healthy living, healthy eating, and physical activity. While many of the developed world will become grayer and older, India basically has to make sure that it remains healthy before it becomes richer. As we roll into a new calendar year, it is important to remember that a healthy Indian individuals I think some content has been closed. The healthy Indian population is a precondition for a healthy Indian economy. And that is the most important challenge, along with energy security, along with a robustly healthy financial sector. These three will ensure India's economic dynamism and resilience as we go into the rest of the decade. I wish you all, therefore, a sustained and sustainable happiness, health, productivity, and purposeful activity in 2024. Thank you very much.
Thank you very much, Dr. Nageshwaran. Well, of course, I think very rightly mentioned the resilience needs buffers. And for creating the buffers, what do we need? And more so when we are embarking upon Amrit Kal, which means a developed economy, developed country. And for that to really happen, perhaps we need to invest. Perhaps we need to really invest in terms of creating capability of becoming a developed economy. We are doing well in terms of exports as far as the services are concerned. Initiative is in terms of becoming a leading exporter as far as manufacturing is concerned. I think it is also, I'm quite confident that it will start yielding results maybe in the near term too. But Doctor, I would have a question, particularly when we are observing across the globe, we have got a situation where the inflation or the interest rates are likely to come down in US. And also, we will perhaps have much better economic activity across US and Europe too. And would you not have a fear in your mind relating to imported inflation through the crude oil? Because as a country, we don't have any challenge when it comes to capacities, but we do experience challenge when it comes to import and import that too of crude oil. So what would be your thought on that particular subject, Doctor?
Thank you, Mr. Kara, and that's a valid question. And I think while interest rates may be coming down, stimulating economic activity, these things happen with a time lag. In fact, the reason why interest rates are expected to come down in the United States, for example, is that economic activity might be noticeably slower in 2024, resulting in lower inflation, than facilitating the central bank to lower interest rates. And therefore, the expected cooling of economic activity will happen first before lower interest rates kick in, leading to hopefully sustaining the economic growth rate without falling into a recession. That is the sort of the Goldilocks scenario that the market is anticipating. So even in this Goldilocks scenario, there will be a noticeable cooling of economic activity first before lower interest rates happen later. Given that, therefore, I don't think energy demand will necessarily pick up sufficiently enough in the course of 2024 to see oil prices spike up. That's on the demand side. However, the concerns that we have, and which you articulated very well, are with respect to supply as well, given what is happening in terms of the cargo movement on Red Sea and other geopolitical, fluid and dangerous geopolitical situations elsewhere in the Gulf region, etc. And that, of course, is very difficult for us to predict how they will play out, because there have been lately warnings by, of a possibility of the conflict expanding into wider conflagration, etc. So those factors are there. However, this is going to run into the challenge of slowing demand. If prices rise, they will further cool down economic activity. So at this stage, I would consider and accept it as a theoretical risk factor for 2024 or even beyond, but one to which I will attach a relatively lower probability at this stage of being a major downside risk for India's economy in FY 2025.
Thank you, Doctor. The other question which crosses my mind is essentially relating to, since we are embarking upon achieving a growth rate which should be on a sustainable basis, at least 10 plus years, should be about 8% plus. So which very clearly means that we need to have the savings also commensurate to that. How do you see that kind of a scenario going forward?
Yeah, so obviously in economics, macroeconomic savings is sort of endogenous to income generation, which in turn comes from employment, and paradoxically that in turn starts from investment. So it is basically what we see is right now the government has done its bit in making capital expenditure its priority in the last several years, including by nudging state governments to do so by offering them interest-free loans. As I mentioned in the course of my remarks, it is now we are all expecting the private listed corporate sector has indeed started to invest, but we need to focus on the unlisted sector and its capital formation, which probably is coming through partially to recovery in the real estate sector, etc. That in turn generates employment growth, income growth, which in turn raises the household savings rate, and so on, in raising tax revenues for government. So in that sense, paradoxically, the avenue to raising the savings rate is going to come from the pickup in investment or capital formation by the private sector in the coming years, leading to employment generation and income growth for the households. That is the route through which we will be realizing the highest savings that will be required to sustain the investments going forward, because all these factors, as we know very well, are endogenous in the macroeconomic framework.
Thank you very much. Any questions? Maybe may I request the audience, if at all they have any questions to ask? Okay, thank you very much, Doctor, for your time. And despite your pressing engagements, you could spare your valuable time and to be with us to give a broader perspective in which we can perhaps deliberate further. Thank you very much once again, Doctor.
Thank you, Mr. Kara, and I really hope that I get the opportunity to be with you in person in this next edition. Wish you all the very best for the rest of the conclave and also for the new year. Thank you.
Thank you, gentlemen. With that, we are going to break for lunch now. We're going to reconvene at 2:30 p.m. So in half an hour from now, we will be back at 2:30 p.m.